And here are your top stories. Central bank bonanza. Yes, it is a pivotal week for markets with no fewer than 11 meetings, including the Fed, the ECB and the BOE. Stocks kick off in the red while the dollar climbs. COVID concern, China equities drop amid the rapid spreads of virus cases. Plus, power surge. London wakes up to the season's first snowfall as heating demand drives energy prices to records. Meanwhile, the UK bracing for a prolonged series of strikes.
Now let's take a look at the futures. Tom, for the moment, we're seeing a bit of pressure on the FTSE, the DAX futures, and elsewhere as they await, of course, all the central banks to decide on what they do with interest rates.
Yeah, producer prices building into that picture on Friday, coming in higher than the forecast. And the question really as to whether or not Jay Powell will be able to convince the markets that these rates are going to be held for a longer period of time than many market participants are currently pricing in. Currently, the FTSE 100 range band, as we look at the strike action and of course, the energy chaos across this country. The Bank of England coming through with its rate decision on Thursday. Currently, the FTSE 100 now down 0.2%, off 20 points. Over in Spain, the index down 0.3%, off by 28 points. Let's switch it over and see how things are shaping up then after the losses on Friday over on Wall Street. Again, on the back of the disappointment that PPI, producer prices, came in slightly higher than expected, above 7% year on year. Futures pointing just down by about 0.1%. Of course, the importance of the CPI data then out on Tuesday before that Federal Reserve decision and how that informs the thinking of the FOMC. Euro dollar 105, that is a drop of 0.2%. We talked in the headlines about how dollar strength could come through across these markets this week. The 10-year at 3.54, that's a move of 4 basis points lower, and Brent, $76 a barrel, that is a gain of 0.2%. The Russian threats to cut production, an area of volatility for this market, but you could looking at 2 straight quarters of losses for oil for the first time in quite some time. So that's a check across these different assets. Let's get over now to Bloomberg's MLive managing editor, Mark Cudmore. Fran, you're going to link over.
Yeah, so we'll get to Mark in a second. Let me just show you what's going on the markets. Now, out of the 19 groups that make up the stock 600, all of them are in the red. So we do have a couple of financial stocks that are seeing a bit of a boost, but it's really individual movers. I'm looking at financial services. They're flat. They're, I guess, the industry group or the sector that's losing the least. On the bottom side, I have basic resources, retail, and technology down between 1.2 and 1%. So, as Tom promised, let's get over now to our Bloomberg MLive managing editor, Mark Cudmore. Mark, I know it's a big week for central banks, so you're getting no sleep, but today you're looking at U.S. real yields.
Yes, good morning, Fran. It's massive event risk this week, not just all the central banks, but also US CPI. And I think, given the rallies we've seen in assets over the last couple of months, I think we're probably skewed for a slightly negative reaction on the surprises we might get this week. I'm focusing on real yields. Now, the first half of this year, we were talking about US real yields almost every week as we saw this incredible rebound. This red dotted line is the zero, and basically all the US real yields turned positive this year, and that was not the expectation at all. That drove that massive dollar rally. The dollar rally peaked in September. At the same time, these US real yields peaked, and it was seen as the big driver. And it was that move in US real yields and the dollar strength that was seen as weighing on stocks through the tightening of financial conditions. Now, suddenly, in the last couple of months, these real yields have drifted a little bit lower overall. It's partially through inflation expectations, and it's also partially through a pullback in nominal yields. And since then, we stopped talking about real yields if we don't really care. I think there is still upside potential in these real yields. 10-year real yields are about 75 basis points below the 50-year average if you take the kind of longer-term Fed data. And that is an environment we've got extreme inflationary pressures. Now, you've got lower potential growth nowadays, so maybe real yields shouldn't get as high as they were in the 70s and 80s, but I still think they're skewed too low. So that's something to bear in mind as we go to the CPI print tomorrow, FOMC Wednesday. I think there's upside potential for real yields in 2023, and I think if we do get a move higher, that might see a spike higher in the dollar and more pressure on equities.
Okay, potential further upside for real yields. Bloomberg's MLive managing editor Mark Cudmore. We can put that question to Laura Cooper of BlackRock shortly. And let's bring it back to the macro then, or stay on the macro. Huge week, of course, lying ahead for the world's biggest central banks. Rate decisions, yes, due from the Fed, the ECB on Thursday, the Bank of England on the same day. Laura Cooper, BlackRock senior investment strategist, joins us in the studio. Laura Cooper, before we get onto the question of real yields, but it does tie in, the market's not getting the message so far from Fed officials that, yes, we may be stepping down to 50 basis points this week, but the expectation is, or at least the messaging has been from Fed officials and Jay Powell, is that rates will stay at elevated levels for a sustained period of time. Markets not believing that part of the message. What is behind that disconnect? Are the markets right, or are they setting themselves up for a shock?
Well, I think the way that markets are interpreting it is that this is a traditional business cycle in the sense that we typically see the Fed cut policy rates in response to deterioration in economic activity, whereas the Fed messaging this time around has been clearly different because they are inducing this recession in order to try to fight these inflationary pressures. So I think that's something to watch for in the FOMC on Wednesday, is the guidance going forward in that dot plots about how the Fed actually expects them to embark on this easing cycle this time around and how long we will be at that terminal rate in those restrictive levels.
So, Laura, is it too soon to call peak inflation?
Well, it depends where you're looking at peak inflation. Certainly, I would expect in the U.S. that's likely going to be the case. I think that this week's CPI print will be quite crucial to kind of add to that narrative that we are in this environment of easing price pressures. I would expect that the market reaction is probably tilted a little bit more to the risk-off bias should we see another upside surprise. But ultimately, I would expect that the CPI print is really going to set the tone for trading through the back end of the year, because we are in this environment where markets seem to grasp at any kind of data to try to gauge where price action should be.
Where is you talked about the dot plots and the fact that we're going to likely get revisions on Wednesday, Thursday from the Fed and those officials. What is your, look out to 2025 for us and give us your trajectory for rate hikes and how equity markets might be adjusting to that?
Well, I think that's a great question. I think, first of all, when we think about the terminal rate, it's likely going to edge higher. We've heard that from the FOMC speakers, that they do expect that's going to be the case. What's been really interesting is the severe disconnect between what we're seeing in market pricing for cuts in 2024, 2025, whereas, as you mentioned, the dot plots, we're wanting to know what that is. So we expect we're likely going to see 100 basis points of easing in 2024 come through on the dots, 100 basis points of easing in 2025. So ultimately, that brings us to around a 3.125% range. So still kind of above where markets are pricing in from that long-term perspective. So it's really interesting, though, that easing expectations has really underpinned the risk rally that we've seen on the back end of those yields. So I think it'd be crucial to see how risks respond to the dot plot.
I have to say, John Arthur's really made me chuckle with his piece today, because he called it, lead us not into inflation, the temptation to call the end of inflation. If you look at central banks around the world, and we're definitely in a risk-on mood this week because of so many central banks, who has the biggest, I guess, policy mistake concern? Who you think could get it wrong?
I think ultimately, when we look at the week ahead, the key focus, probably from my perspective, will be on the Bank of England, notably because we did have some dissent last meeting where two members didn't vote for that outside 75 basis point hike. So this time we're likely to see a three-way split. And I think that just captures the sentiment overall by policymakers around the uncertainty about the outlook going forward. And we're in a period in the UK that's clearly in stagflation. So how do policymakers try to navigate these elevated price pressures in this economic contraction period?
The other big story, of course, beyond the central banks is what's happening in China, the disorderly exit from COVID-0 that we're starting to see. How does that inform your views about how much exposure you want to that economy and equities?
Well, it's been quite interesting that we have seen this exuberance on the back of this reopening trade start to be tempered somewhat by the rise in cases that we are seeing, as you mentioned, that disorderly type of reopening. Now, when we take a step back, ultimately this does position for a weaker Q4 than we had initially expected, but we do expect more of a rebound next year, so that should provide some conviction overall in the Chinese growth backdrop. But when we look at our asset allocation, we're still underweight, largely because we do think that there is a risk premium needed in order to provide investors with some of the risks that we are seeing come through, because we don't think that the policy is going to be kind of that stimulative measures anymore, but rather just more of a lower trend growth, kind of steady going forward.
So we also have a huge energy crisis. I know we'll get back to China in a second with also a reporter on the ground, but when you look at the energy price, and yesterday was, I mean, crazy really. In the UK, I think prices went up some 45 times. Are we underestimating the pressure of which energy will give to consumers, or will bring on consumers in the next 2 months?
That probably is the case. I mean, certainly we have seen markets react quite favorably to the fact that so far this year we have seen energy prices come off their recent highs. But ultimately, we do expect that the European economy is probably most challenged by this backdrop. Notably, we do think that Europe is already in a recession. We do think that's going to be prolonged through 2023. So we do think that's quite a problematic kind of backdrop. And when we're positioning for this, we don't think that European equities are accurately pricing in that recession risk. And that's crucial in terms of being more selective in terms of portfolio exposures.
How defensive do you want to be then within the European equity space?
I think there are pockets of cyclical opportunities. It's really about what's in the price and finding those different market dislocations. So European banks continues to be a conviction trade for us, which, yes, even though we are in a European recession, we do think that the backup in yields will provide enough of a tailwind to provide some positive uplift there. But we ultimately are still kind of preferring the defensive tilts within this space. Again, the healthcare, kind of those that have the stability of earnings, those that cash resilience, where you want to have exposure in this type of environment.
Okay, Laura Cooper, excellent. We'll get more of your thoughts on China, more of your conviction calls as well as we look ahead to 2023, just in the next few minutes. Laura Cooper, BlackRock Senior Investment Strategist, staying with us. Just updating you on what's happening with Moller Maersk then. Big news there in terms of changes at the top. So you do have Vincent Clerc taking over from Soren Skou as the new CEO. They will be replaced. Soren Skou is going to be replaced, as I said, by Vincent Clerc. The current head, Vincent Clerc, currently the head of the transport giant's ocean and logistics business. This change will begin on January the 1st as part of what they're describing as a planned CEO transition. Just checking in on the stock on the back of this. Of course, we are going to be speaking to Maersk just in the next 25 minutes or so. The stock currently down around 2% on the back of this news. We are going to be speaking to CEO Vincent Clerc, as I mentioned, as he prepares to take over. A big story within the shipping industry, of course, so stay with us for that. Fran.
Coming up, Beijing is asking COVID patients with mild symptoms not to call the medical emergency hotline. So more on the country's reopening risks. That's coming up next, and this is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Welcome back to the Open, everyone. Happy Monday. We are 14 minutes into the European trading day. Certainly, if you live in London and made it to the office, well done. You've had to deal with snow, freezing winds, and of course, a lot of sleet. Now, European equity futures, actually European equities in all, not futures. U.S. futures and European equities are down some 0.5%. The focus very firmly on the rate outlook. I think we have some 11 central banks actually deciding this week, but it's really the Fed, the ECB, and the BOE that will move the markets the most. Fed's peak rates are seen dashing some of the investor hopes for the 2023 cuts. And of course, there's maybe a bit of adjustment also as trading volumes could get a little bit thinner as we get onto the holiday season.
Yeah, and mainland and Hong Kong stocks selling off in the session today after top Chinese officials. They have continued to downplay the risks of COVID-19. That's as cities across the country ease restrictions. Bloomberg's John Lill joins us now with the latest. John, what are we seeing on the ground as China tries to wrestle with this COVID-0 exit?
So I think what officials are trying to do right now is to assure the public that if they are infected with COVID, that they do not need to go to the hospital, that they can self-medicate and recuperate at home. That is the big battle now. We've seen the healthcare system coming under increased strain as infections increase here in China. We've had doctors being called back from time off. We've had doctors and nurses being told that even if they are infected with COVID, if their symptoms are light, they should return to work. There are just too many people coming into the hospitals right now.
So what's the potential significance, John, of China reopening its border with Hong Kong?
Well, China still has a very strict quarantine requirement for anyone coming in from overseas, 5 days in a hotel, 3 days at home if you live within the mainland. So that's the next thing that we're expecting to get rolled back, those quarantine requirements for overseas travelers. And obviously, if you live in Hong Kong, if you're a banker, a business person who lives in Hong Kong, but most of your business is in the mainland, seeing that restriction lifted will make your life a lot easier. We could see much more business being done across the border there. And so that's what people have been looking forward to.
Okay, so John, you're watching what happens on the border between, of course, Guangdong and Hong Kong. What else are your team kind of looking ahead for in the days and weeks ahead as we look at this kind of scramble for medication and the pressure on the hospitals across the country?
So as China has stopped testing the population as stringently as they have been before, the number of infections is not really telling anymore. The number to watch will be serious cases of illness. We are keeping a very close eye on that. And then the reports of deaths from COVID as infections continue to spread. Obviously, it'll put a lot of pressure on the authorities to do something if deaths do start to climb significantly. Also this week, we are expecting the Economic Work Conference, where senior leadership will be planning out the economic plans for 2023. And so we'll be looking out for what they say they're going to do to try to make up for this hit that the economy is going to take from COVID.
John, thank you so much. John Liu there, of course, who oversees all of our coverage for Greater China. Now, China rolls back on COVID zero. Just how are investors adjusting their risk outlook? A Bloomberg survey of 134 top fund managers, some most saying they are bullish on Chinese equities for 2023. Laura Cooper, Senior Investment Strategist at BlackRock, is still with us. Laura, I know you've already mentioned how you would play the China strategy, but if you look at some of the commodity currency countries, I'm thinking of New Zealand, Australia, but many more, what happens to them in 2023?
Well, I think what's the difference this time around with the China rebound in growth? I mean, we're penciling at about a 6% handle on the back of a very low base from this year. But ultimately, this is not going to be geared towards infrastructure investment that would typically have that spillover in demand for global commodities. So we don't think that China is going to act as a ballast in a global downturn to get us out of that in terms of an upswing, because it's the investment is going to be directed more towards the domestic reopening rather than those external factors.
We spoke to Goldman Sachs, Sharon Bell, saying, look, one way to play this is you buy a slice of the FTSE 100, which has some exposure in terms of the big miners, and then maybe you buy some of the luxury, maybe some autos within Europe to get some of the exposure. Would you align with that view, or does that pose a challenge, do you think?
That does align with kind of the BlackRock 2023 outlook in the sense that this is a new macro regime. There's going to be elevated macro volatility, elevated inflation volatility. So this does require a new investment type of playbook that ultimately requires being quite selective in exposures. So it's seeking those type of opportunities like the luxury sectors, like energy within the UK, that we think are still mispriced and are likely to have some upside next year, despite what we are seeing in terms of this prolonged risk-off sentiment.
But Laura, for example, so how do you choose, if you look at the luxury sector, you know, some shares really flew off the shelf in the last 6 months and some are really under pressure, and it's more the ones, I guess, skewed towards technology. Like are they priced to perfection already?
I think that's a great question. I mean, certainly when we look at the sector overall, we do still like it because of its tilt more towards those consumers that are going to be more resilient in this environment where those kind of consumption challenges will become more acute. But ultimately, I think it comes down to the portfolio level being quite selective, quite granular, and looking for those stocks that are probably not yet priced for perfection, as you say.
Highest conviction overweight call for 2023 is investment grade corporate bonds. Is that US? What within that basket are you looking for? And explain the rationale for that call.
Yeah, it's a great, I mean, I think ultimately this is a position that we went overweight in July, and we think that overall the corporate balance sheets remain fairly healthy and resilient enough to withstand earnings downgrades that we are expecting to come through, be able to withstand that more than we think the equity space is going to be. Now, this isn't a call on spread compression. If anything, we think US investment grade spreads are likely going to trade in their recent ranges, but ultimately, you know, as we look back to the latter part of next year, that's when we could potentially see some spread narrowing. But this is really a call on all-in yields looking quite attractive from a coupon perspective and really providing that shelter in this type of uncertain environment.
Okay, Laura Cooper, always excellent. Have a great holiday. We'll see you in the new year. Thanks for coming in with that overweight call on investment grade in 2023. Laura Cooper, Senior Investment Strategist at BlackRock. Right, coming up, Microsoft takes a bite out of LSE, taking a 4% stake with a 10-year cloud deal. We'll check on LSE's share price. I can tell you it's up. That is next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Welcome back to the Open, everyone. 23 minutes into the European trading day. European equities on the back foot at the start of a pretty pivotal week for the markets. That's also how Mark Cudmore put it together. Interest rate decisions due from the Fed, ECB, and of course a host of their peers. For the moment, you can see European stocks down 0.7%. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Microsoft has agreed to buy a stake in the London Stock Exchange Group, giving it a 4% equity holding. The US software giant will acquire shares held by a consortium made up of Blackstone and Thomson Reuters. The stake is part of a broader 10-year partnership to help the LSE owner develop data analytics and cloud infrastructure. Amgen is said to have agreed to buy Horizon Therapeutics at a valuation of about $26 billion in what would be its biggest ever acquisition. The US biotechnology giant offer is at a premium to Friday's closing price of about 20%. Potential buyer Sanofi backed out of a deal on Sunday after takeover reports pushed Horizon's market value to $22 billion. Twitter will relaunch its Twitter Blue subscription service on the web on Monday for $8 per month. The company says Apple's iOS users will also get access for $11 per month to subscriber-only features, including the blue checkmark. The relaunch of Twitter Blue was suspended in November due to a wave of profile impersonations. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. We are going to zero in on a couple of the individual corporate stories. There's some good deal stories to highlight for you this morning. LSE Group, and of course Alice kind of touched on some of the details around this, but that stock rallying on the back of this deal, the investment by Microsoft in LSE Group, buying up the shares of Blackstone, Thomson Reuters, about 4% stake in that company that Microsoft's taking. Morgan Stanley, interestingly, saying this is going to improve LSE's data offering and revenue growth. Microsoft, they hope that this partnership, as they've said, is going to generate about $5 billion worth of revenue over the next 10 years. So there's the LSE up 4.5% on the back of that. Novozymes, big drop there, 13% on a merger with Christian Hansen. These are two enzymes or probiotics businesses based in Denmark, so taking a hit on the back of that merger. And you've got Moller-Maersk, of course, change at the top with a new CEO. This is part of the transition. We are going to be speaking to the new head of Moller-Maersk. He'll be taking over on January the 1st. We'll be speaking to him. That is Vincent Clerc, the current head of the transport giant's ocean logistics business, just in the next 5 to 10 minutes or so. So stay with us for that important interview. The shipping giant, of course, and change at the executive level. There is plenty more coming up as we cross and focus on these markets ahead, of course, of this massive week for data and central banks. Currently, European stocks benchmark down 0.7%. Futures lower in the US. This is Bloomberg.
grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Central bank bonanza. It's a pivotal week for markets with no fewer than 11 meetings, including the Fed, the ECB, and the BOE. Stocks kick off in the red while the dollar climbs. Power surge. London wakes up to the season's first snowfall as heating demand drives energy prices to records. Meanwhile, the UK braces for a prolonged series of strikes. And logistic change. Maersk tips Vincent Clerc to become the new head of the shipping giant, replacing outgoing chief executive Soren Skol. After 6 years at the top, we'll speak with the incoming chief executive shortly.
Okay, let's check in on these markets. Currently, the European benchmark down close to 0.7%. We'll get into the sectors shortly, but of course, you have all that central banking action to take on board. You've got the consumer price index coming through from the United States on Tuesday after PPI, producers' prices, came in stronger than expected. And again, will Jay Powell be able to get the message across, finally, that these rates are going to be held for longer than many market participants expect? That is something that's going to be focused on. Then you have the BOE, of course, and divisions there. We'll break down that story in the next minute or so as to where the BOE goes at a time of this energy crisis here in the UK, industrial action, and of course slowing growth, and then the ECB on the same day as well. So just a massive week for these markets. Again, across the benchmark, you're seeing losses of 0.7%. Here in the UK, as industrial action kicks off, they've got the FTSE 100 down 0.3%. Over in France, losses of 0.6%. And in Germany, the DAX down 0.7 or 98 points. Across your sectors, losses most pronounced in the auto sector. Interestingly, a redhead just crossing in the last few seconds. Rivian over in the US and Mercedes-Benz cancelling a planned European electric van JV. The sector more broadly down 1%. Utilities, of course, a bit of a safe haven tilt there. Still off, down 0.3%, but at the bottom of the list in terms of not producing the same kind of losses that you're getting at the top of the list with autos and banks facing some of the heavier losses. In terms of what is happening then across your bond markets, also worth pointing out that yields are lower across the Treasury curve from 2s to 10s. Currently, movement in the 10s at 354, yields off by 3 basis points. But it is really the focus on the UK, at least for now, as we look at the FTSE 100 down 22 points, that draws our attention, Fran.
Now, the UK economy grew faster than expected in October. This as businesses recovered output loss following the extra bank holiday for the Queen's funeral. In fact, GDP expanded 0.5% month-on-month. Estimates were of 0.4%. So nothing huge, but a slight better than expected figure. For more, we're joined by Bloomberg's Lizzie Burden with the very latest on GDP. Then we're looking also at energy prices, strikes, and the chaos that is the snow. I mean, everything literally is grinding to a halt in London. So, Lizzie, what was the main surprise in that GDP data?
Well, it wasn't really a surprise at all. It was just a very slight upside beat compared to economists' expectations, 0.5% month-on-month in October. But it was wholesale and retail trade that made the biggest contribution to growth. We've had the reactions from Jeremy Hunt, the Chancellor. He says, I want to be honest that there's a tough road ahead, even if there is a bit of growth here. And Rachel Reeves, the Shadow Chancellor, says these numbers underline the failure of this government to grow our economy. But really, I have to say, this doesn't move the dial for the Bank of England this week. What you may see is more of a surprise in the jobs data. Tomorrow, we're expecting to see a cooling in the labour market. We also get inflation data on Wednesday. We're expecting to see that inflation's past its peak. But as you hinted, Tom, what we may get is a four-way split. That's certainly what Bank of America and Nomura are hinting at in their notes recently. That's if Swati Dhingra and Silvana Tenreiro, the big doves on the committee, vote for no hike at all or 25 basis points.
Okay, a four-way split. Energy, of course, part of the decision-making, the BOE, in terms of the drag on the economy. Well, I'm looking at Dutch futures. They're currently down 7.8%, but there's an energy shock here in the UK. What's that doing to power prices?
Yeah, I mean, enchanting as it was this morning, I don't know whether your dog enjoyed it, Francine, mine certainly did. It is bad news for UK power prices. The consumption is rising. It's expected to peak today at 5 p.m. as people turn up the heating. And as a result, you've seen the day-ahead price on the EPEX spot exchange for the 5 to 6 p.m. hour clearing an all-time high of £2,500 per megawatt hour. And to make matters worse, of course, in the UK, we're very, very reliant on wind-generated power supply. There's almost zero wind this morning. So it's a very, very difficult moment. If you can afford to have the heating on, if you can work from home, today's the day.
Yeah, I have to say, my dog was so shocked. He was like, a gilt trader when the gilt collapsed. He was like, what is this white
I like the linkages to gilts there.
See, always back to
one of the
gilts.
cutest dogs, surely, in London is Francine Schnauzer in the snow now. We need to see images of that. There's a breaking news story. We're just going to bring you more details. I did touch on this. It was a redhead across the terminal about 5 minutes ago. This is Rivian and Mercedes-Benz. They're cancelling their planned European electric van JV. So the details. Rivian walking away from these plans to build electric vans in Europe, Mercedes-Benz. That was a deal that was signed 3 months ago to share costs and scale up production. The details then from Ed Ludlow reporting on this for Bloomberg. Rivian will no longer pursue the MOU signed with Mercedes in September. And that did include plans to invest and jointly operate the existing Mercedes vans plant. It seems that this company, in terms of where it's based, of course, Rivian's based in California, just updating on that news. In terms of the impact then on the Mercedes price, let me just pull this up on the intraday. You're looking at just a drop of 0.8%. Whether that's tied to the story or not is unclear because the broader sector, autos, is lower for the morning. Let's get more on the market analysis then and how you might be thinking about positioning as we head in to 2023. But before we get to that, let's unpack energy a bit more. We touched on it with Lizzie, what is happening in the UK, and I touched on the fact that Dutch futures are currently lower on the session, but of course this is a huge question, not just for this year, but into 2023 as well. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, is here to unpack how energy plays or feeds into your views around equities into next year. We have the European story, very different to the US story, of course, and then the UK with its own idiosyncrasies.
Right.
When it comes to Europe, and the capacity build-out that we've had in terms of gas storage, but then looking to 2023 with all the volatility around Russia, threats of cutting production, how do you unpick, how do you get clarity on the playthrough of energy into the equity space as you look to the 6 and 12 months ahead?
Yeah, I think the sort of overarching theme is we already priced in pretty hefty expectations for a downdraft in growth as a result of higher energy costs. But really what may matter more than anything is just how much governments are subsidizing and limiting the impact of energy costs throughout the different countries. So it becomes a very significant country-level story. For instance, Germany spending more than 7% of its GDP on containing energy costs, limiting the impact of a reset in energy costs on their ultimate consumers, versus other nations spending very, very little. Right? And I think that that'll make a pretty big impact on equity performance, mostly because it will be one of the bigger drivers of the depth and duration of the economic decline as a result of this energy. When we have less discretionary funds as consumers to spend elsewhere, it results in an earnings compression. And I think that's going to be a pretty big story into 2023.
Gina, also congratulations to you and to everyone at Bloomberg Intelligence for the great, research that you're putting out. So when it comes to a recession 2023, you're expecting, because of a number of factors, maybe for it to be milder but more drawn out.
Yeah, especially for the U.S. I think this is really a U.S.-centric story where We think that the earnings stream, anyway, actually peaked all the way back for the S&P 500 X Energy. It peaked all the way back at the end of 2021. So technically, earnings for the S&P have been in recession throughout 2022. And I think that's important to keep in mind because that's been a lot of the pricing dynamic and the weakness that has evolved in stocks this year has reflected that downdraft in earnings growth, in addition to, of course, the reset in Fed policy. We anticipate that earnings recession to get worse into 2023, and certainly last week's breakdown in oil prices would suggest that energy even may partake in this sort of earnings recession going into 2023, deepening the decline for now. But as the comparisons start to get easier in 2023, we anticipate that the earnings stream will be out of recession by the end of the year. And that is pretty meaningful for thinking about your sequencing of investing, thinking about your cyclicality in your portfolio, and where the opportunities start to emerge.
So within that view, are you on the side that the Fed will be compelled to cut at some point on 2023? Or we were hearing from BlackRock earlier, Laura Cooper, saying, we don't think it happens, the cuts until 2024. Where do you sit in that debate?
I think the Fed will at least pause into 2023. Whether or not they cut is still a 50-50 chance for me. If they do cut, I think it'll be less of a cut than is typical in a recession. Normally, in a recession in the United States, you get 100 basis points of rally in the 2-year Treasury yield as the Fed cuts pretty significantly into that economic downturn. But because we've been in this sort of very slow bleed downturn in the economy and we expect it to deepen, but really more of an extension of that slow recession is the story for 2023, the Fed probably isn't compelled to cut as much as is the norm if they do start cutting. And that's incredibly consequential for the equity outlook because it means there's no big spark to improve risk tolerance. That spark from the Fed is critical to creating the major low followed by a really strong, robust rally. And we unfortunately don't see that as likely next year.
Gina, very quickly, when does the S&P 500 touch a record? I mean, you argue that it could take 3 years. I mean, 3 years is a long time.
It feels very long, Francine. It certainly does. We think our broader, longer-term models, partly because of this dynamic of the Fed not creating that new spark in growth, not creating that new rush to borrow money, is that valuations remain somewhat suppressed longer term. We don't have the big valuation recovery. We also have this sort of extended recession, slow recession, shallow recession scenario, which means you don't get the big, robust earnings recovery either, which results for us in a 3-year fair value model that says we may not get back to those former highs before 3 years. On average, it takes a little over 2. It may take us 3 this time around.
Gina, thank you so much for all of your insights. Gina Martin-Adams, our Chief Equity Strategist at Bloomberg Intelligence. Now, coming up, a change at the top of Maersk. We'll be speaking with the incoming Chief Executive, Vincent Clerc, as he prepares to take over. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom King, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. We are 44 minutes into the European trading day. You're seeing losses across European equities of 0.6%. Here in the UK, the FTSE 100 down 0.2%. They're selling a little bit more pronounced over in Germany. The DAX off by 0.5%. The auto sector a drag. Their futures in the US range bound as we look ahead to the CPI print on Tuesday and, of course, the Fed's decision on Wednesday. Francine.
Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. COVID is rapidly spreading through Chinese households and offices after pandemic rules were unexpectedly unwound last week, with hospitals struggling to deal with the surge in cases. Scenes of disruption are easily visible in Beijing, where anecdotal evidence suggests the caseload is many times the government's tally. This, as a top medical advisor is quoted saying the fatality rate from the Omicron variant is similar to flu. The US will send a delegation to China in the coming days, following up on President Biden's meeting with Xi Jinping last month at the G20 summit. The State Department says the visit is to, quote, continue responsibly managing the competition and to explore potential areas of cooperation. The visit will also prepare for Secretary of State Antony Blinken's planned trip to China early next year. A major investigation into the bribery of European Parliament officials by an unidentified Gulf nation has led to the arrest of 4 suspects, including a lawmaker. Belgian prosecutors raided multiple properties across Brussels on Friday. Federal Judicial Police investigators say they suspect a Gulf country of, quote, trying to influence the economic and political decisions of the European Parliament. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Now to one of the big corporate stories of the day, quite possibly of the week. Shipping giant Maersk has picked Vincent Clerc as CEO to replace Søren Skou. Clerc, the current head of the transport giant's ocean and logistics business, will take over from January as part of a planned CEO transition. We're very pleased to say that we are now joined by Vincent Clerc, the incoming CEO of Maersk. Vincent, good morning. Congratulations on the new role, which you'll be taking from January the 1st. Explain to us the board's thinking in making this change at the top and how you're thinking about any changes to the strategy for Maersk in the years ahead.
Good morning. I think the thinking of the board was that after 2 years of very, very abnormal markets, we're clearly landing now into a very different world from the one that we knew prior to the pandemic in 2019. A lot of things have changed, and we're heading into a season now with energy crisis where our customers are impacted, where a lot of the challenges that we have will require a strong focus across the organization. What we have also developed over the past few years is a strategy that works extremely well, that can cope with this, even if some of these challenges will require extra effort. And so they felt that making a change at this time, as we just signed off on a record year in the history of the group, was really giving the opportunity for a new team to step in and look at the world, the new season that we have ahead of us, with a fresh pair of eyes and really be able to take the company through this. From a strategic perspective, we're going to continue the execution of that strategy. It has led us to, I think, very successful performance in the last few years. The team is fully bought into what we have to do, and customers are really excited about what we're going to market with.
Mr. Leclerc, container freight rates are falling pretty drastically. How are you planning to reverse that?
Yeah, so what we're seeing is after the couple of years of very high demand during the pandemic, we're seeing an inventory correction right now. We had expected that. We see a rapid normalization of freight rates. In the short run, they are likely to possibly undershoot a little bit for a period as our customers actually right now correct inventories and therefore move fewer volumes than what they normally need to from an underlying consumption perspective. So what we're doing here is really a strong focus on our cost base, strong focus on offering the capacity only that is needed for the volumes that are moving today, and focus also on operational cost, continued focus on operational excellence in order to weather this difficult period. But I think what is important to remember is these inventory correction, they only last for so long. It's about hunkering down, making sure we got our basics in order, and the team is all over it.
Vincent, let me just unpack a little bit of that, because the details around the shipping rates, you said they're likely to kind of remain low for some time. Where does that take you into 2023? How much more downside to shipping rates do you expect to see? And as we face up to these recession risks, what are you seeing in terms of your customers, your clients, in terms of the slowdown in exports and global trade? We saw, for example, the data out of China with their exports looking softer. What are you seeing in terms of the detail on the data?
Yeah, so what we're seeing is clearly a demand going forward in 2023 and 2024 that will not be at the level, at the record level that we have seen in 21 and 22. Partly because demands for some of the commodities that were in especially high demand during the pandemic, like durable goods and so on, this has really abated right now and is normalizing rapidly. Exactly what this means from a demand perspective is hard to say at this stage. We're seeing this unfold. I think we see this inventory correction now. We expect it to last it through probably another few months before we see volume pick up again out of Asia and to align themselves more with what we're seeing as being the underlying consumption. Normalizing of freight prices, as you mentioned, has happened to a large extent, and they have already come to levels that are pretty critical. And we are therefore already taking pretty sizable measures to restrict capacity, to lower our cost base and make sure that we can weather this in the best possible way.
What kind of recessionary environment are you expecting for 2023? There's a debate on whether it's short and ugly or whether it's long and protracted but shallow.
Yeah, I think we need to really split the world here, because what we are seeing so far is actually emerging markets where we do the majority of our business are significantly more resilient in the demand than what we're seeing in some of the traditional mature market. We're seeing also in the U.S. an underlying consumption that continues to become quite strong, and there we can be optimistic still that if there will be a recession, it should be fairly short. Europe is, of course, battered by a very strong energy crisis. The mood when you have a war on the continent is, of course, not as easy to withstand. And there, I think we have a bit more of a pessimistic view with respect to what demand is going to look like for next year. But it is something that we will need to ascertain in the coming months. The important thing for us here is really that we have an organization that is agile, that we have a business model that is much more agile than it has ever been, and we're able to withstand these types of swings in demand much better than we were in the past.
Do you feel, Vincent, like you have much clarity when it comes to energy costs? It's another big topic of conversation today. I'm thinking of oil, potentially 2 straight quarters now of losses for oil, but then you have Russia threatening, of course, to reduce production and output. Are you putting in place contingencies around the energy input to the business?
Yes, we are. That's a really good point. We are actually doing everything that we can and focusing on the efficiency of our operation. And we will implement lower service speeds in the coming quarters to make sure that we reduce our exposure to these cost inputs to the maximum possible. These are significant inputs, obviously, to all transportation activities and something we're managing very closely.
Vincent, overall, how do you measure success? And actually, I know, we talked about freight reversals. We're talking about some of the things that you may or may not do, including M&A. I don't know whether that's something that you'd be interested in, but do you give yourself 6 months to turn it into something where share prices increase, or will it take longer?
That's a really good question, and certainly something that we will be looking at in the month to come. I think that what is important for us is that the platform that our strategy has given us over the past few years is a really, really solid platform with a lot of leg to it, even in the context that we're looking at. And so we will continue to double down on that strategy and continue the growth that we're having, the diversification of the activities, the growth in our logistics business, the growth in our terminal business. We'll continue to do that. At the same time, we have circumstances that we just discussed that require that we do actually take a more defensive posture with respect to ocean shipping. We will do that. We've done that in the past, and we will weather this storm, I'm pretty sure, the way that we have in the past or better.
Vincent, thank you so much for joining us. Incoming Maersk Chief Executive Officer Vincent Clerc. Now, a huge week lies ahead for the world's biggest central banks. Rate decisions are due from the Fed, the ECB, the Bank of England, and actually 9 others. So joining us now is JP Barnett. He's Bloomberg's senior reporter on global equity markets. And JP, I guess stocks are dropping as central banks are keeping traders on edge.
Yeah, absolutely. It's going to be a busy week with a lot of potential of things can move quickly in either direction, and that's usually not an environment that investors like pretty much. They rather stay on the sidelines, see what's going on, and then move back in. Also, if you look at options data as just one example, there's a huge amount of open interest in options that are expiring over the next 3 days. So this is another area where you can clearly see there's a lot of uncertainty in the market in this week, and it's probably rather a safe bet if you want to stay out of that for the moment.
JP, we've seen quite a lot of deal activity just in the last couple of hours. In fact, this morning, I just wonder, as you look ahead to 2023, how much you think deal activity, M&A acquisitions, is going to be a catalyst for these markets or not?
Well, I'm not so sure, actually. I guess it's going to be less vibrant next year, and that's probably also the reason why some of the companies are trying to make a move right now. When the economy is cooling and the markets are going to have a difficult time, I'm not so sure if M&A will have an easy time there. But also you can see that there are still enough companies out there who are cash rich, who have a solid business model, who I guess the management is expecting that the recession will not hit them too hard, and that it's a good time to look around if there are some cheap options out there in the market to buy up.
I don't know, JP, whether there's a place in the market where you could see the biggest value as we get into, I guess, the high volatility season, as we get into the holidays and Christmas.
Well, I would still say I go with what we heard from our survey last week, that you probably want to look for those companies who have a solid balance sheet, who have a stable cash flow, who have a lot of reserves on their balance sheet so that they can weather the storm, as we just heard from the Maersk CEO, incoming CEO. And you want to go probably in the more defensive areas like healthcare or infrastructure. Those are areas that should probably still offer you some good value, even going into a recession, no matter mild or heavy. I mean, if it's heavy, then I guess it's going to be difficult everywhere.
Yeah, that debate around the recession and the shape of that recession continues. Bloomberg's JP Barnett on the themes and how these markets will be reacting to central banks, of course. The Fed on Wednesday and the BOE and ECB on Thursday, CPI on Tuesday. Thank you, JP Barnett. Currently, your markets here in Europe currently down 0.7%. The future's down in the US by about 0.1%. Of course, uncertainty as to where the next step is for these central banks amid questions over recession. Energy prices back in focus with snowfall here in the UK. Plenty more coming up. Stay with us. This is Bloomberg.
do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Central bank bonanza. Now, it's a pivotal week for markets with no fewer than 11 meetings, including the Fed, the ECB, and the BOE. Stocks kick off in the red while the dollar climbs. Power surge. London wakes up to the season's first snowfall as heating demand drives energy prices to records. Meanwhile, the UK braces for a prolonged series of strikes. And logistics change while shipping giant Maersk names Vincent Clerc as incoming chief executive, taking over from Søren Skou after 6 years at the top. And you can see shares for the moment down 2.3%. Now, first thing is first, so let's check on the markets, European stocks, but also U.S. futures actually declining at the start of a pivotal week for markets because of all those interest rate decisions. Fed, ECB, but also a host of their peers. Investors really looking for firmer clues on how far and how fast central banks will tighten monetary policy from here on as recession fears resurface. I think we also have a map of Europe, if we can see it really quickly. I'm sorry if it's very, very tiny, but we will get to it to see whether there's a difference between the DAX and some of the others. You can see for the moment all in the red, and I'm also looking at the 19 industry groups that make up the European stocks, and they're down. Maersk saying Vincent Clerc taking over from Søren Skou as new chief executive. We'll have plenty more of our interview with the incoming chief executive, Vincent Clerc, later this hour. That share price down 2%. Now we're joined to talk about the markets by Mike Bell. He's global market strategist at JP Morgan Asset Management. Mike, great to speak to you. What a week for central banks, and what a week actually for an investment trader. Like, where do you see the fault line?
I mean, for me, the interesting question is not so much about what happens this week, because I think probably the market's right on what's going to happen this week. The big question really is about where are rates going to be at the end of 2024?
Yeah.
Because the market's already starting to price some cuts. I think that's because the market knows a recession's coming. But is the market pricing enough cuts for a recession? It's not clear to me, both in the UK and the US, that it is.
But so, Mike, is it now given that we're going to see stagflation, even in the US?
I mean, I think the question there really depends on how you define stagflation. I think we're going to get a recession, and obviously inflation is very high at the moment. So in that sense, yes. But for me, the question really is, does the recession bring inflation down? And I think there's a good chance it does. I think unemployment's going to rise to a level that brings wage growth down, and that will moderate the inflation pressures in 2024. So,
Mike, if we look, and we had this great conversation actually with our head of equities, a strategist for equities in the U.S. I mean, there's, I guess, two schools of thoughts, whether this is a deep, ugly recession even in the U.S., or whether it's shallow, we can get by, but we're going to see a readjustment. Which one is it?
I don't think it's going to be that bad. Ultimately, I think what's happening at the moment is that mortgage rates are at a level where very few people can afford to move home. So you're going to see a very sharp decline in home sales, which is already starting to take place. With that, you then start to see fewer homes getting built, and then some job losses in the construction industry, which tends to then lead to further job losses elsewhere in the economy. And so I think that will cause a moderate recession. But the good thing in the US is that only about 4% of people are on variable rate mortgages. So if you just stay put, you can still afford the house you're in, you just can't move. So I don't think it gets that bad in the US. In the UK, it could get worse. If rates stay as high as they're predicted to stay, then I think the UK could have quite a deep recession. But I actually think they're going to cut by more than the market expects.
So, Mike, in the US, first of all, how do you position yourself? Does duration still look attractive?
I think it does. I think that duration looks attractive anywhere north of 3%. My best guess is that by the end of 2024, the Fed will have cut rates to about 2.5%. And that's a bit lower than the market's pricing at the moment.
The BOE is probably the most interesting one because it's where we could see maybe the biggest policy mistake. I mean, how do they get into this Thursday?
It's frankly the trickiest one for them because, you know, they've got all these strikes going on at the moment. There are risks that you see wages really pick up somewhat on the back of that. So they're in a very difficult position. But I ultimately think the UK housing market is in a lot of trouble if interest rates go up to 4.5% and stay there for the foreseeable future. So I think maybe they do get to 4.5%, but then they're going to have to cut by more than the market's pricing. The notion that they'll still be at 3.5% by the end of 2024, that seems to me the housing market would be in a lot of trouble by then. So I think they need to cut more. So
sorry, Mike, the trajectory is what they're actually aggressive now and then cool off in 2023. I mean, that would be a big gamble.
I think they're aggressive now, and then in 2024, they cut by more than is priced.
2024. Yeah, that makes sense. What do you do then with UK assets right now? And there's such a huge difference between the FTSE and FTSE 250.
Yeah, and that's obviously partly been helped by the fact that commodity prices have done very well this year, and it's a big part of the FTSE 100. Also, of course, sterling's been very weak, and 80% of the revenues for the FTSE 100 come from abroad, so that helped as well. So the big risks for the UK market next year are that sterling goes up a bit, and that would hurt the translated revenues. I'd personally be neutral on the US. I think there's good value in US value stocks at the moment.
Mike, when you look at, I guess, you know, to China and further east in general, it doesn't seem that they can get it right. It's either, look, they have to stop COVID zero, or analysts worry that then there's too many people ending up in hospital. How do you play China?
I think there's everything we've seen in the last few weeks suggests to me that they're going to try and move past COVID. It will be interesting to see what that means. It was interesting to see the people, the head of the health authorities out there coming out and saying, actually, maybe if Omicron does rip, it's not that much worse than flu. We'll see if that's true or not. But we know, of course, in the West that Omicron, even for people unvaccinated, has been less bad. So there's a chance that it's not as bad as some people fear if they do let COVID spread. Of course, if they do have to have further lockdowns, then I think that's just going to encourage them to ramp up the vaccinations. And that's the most encouraging thing for me, the fact that they're now being a lot more serious about trying to get the over 60s vaccinated, because that's obviously the way past this in the medium term.
But Mike, I mean, a number of questions actually on the back of it, and how difficult is it to model what the economy does and their appetite for energy and commodities?
Yeah, I mean, ultimately it's going to come down to when they get through COVID, because the economy is going to be weak until they do that. But I do think that there's an increasingly high probability that by the end of 2023, China is no longer worrying about COVID, either because they managed to ramp up the vaccines, that's the base case, or maybe they let COVID go and it doesn't put that many people in hospital because Omicron's more mild. Either way, I think by the end of 2023, China can reopen, and then they can probably do a bit more stimulus, which might boost things like metal demand.
So at the moment, and we look at, you know, some of the commodity currencies, I'm thinking Australia, New Zealand, and others, are they a good value? Like if you look at the markets in 2023, and, you know, we're 2 weeks away or 2 or 3 weeks away from that, so it's a good time as any to have a look. What do you buy?
Hard to say on those currencies because you've got, I think, places like Australia and New Zealand are suffering from higher interest rates and pretty high household debt to GDP ratios. So I worry slightly about the housing markets in places like that. That's the sort of downside. Of course, Australia benefits from high commodity prices if China benefits as well. So I think they're kind of offsetting. I wouldn't take a big bet on it. I mean, currency-wise, it's always very hard to say. I do think there's a chance that if by the end of 2023, the market is starting to look through a recession, that could start to bring the dollar down a bit.
Okay, the dollar, what if the dollar doesn't go down? So what does it mean for emerging markets?
I actually think it's going to be more important for the big emerging markets what happens with China. So if we get this China reopening, then I think EM as a whole are going to have a pretty decent year. But some of the smaller emerging markets could struggle in a world where the dollar goes higher.
ECB, we haven't even touched on ECB. I mean, it's going to be a busy Thursday. What does ECB, like some of the challenges of Christine Lagarde, I mean, they're huge. We also saw energy prices in certain countries like go up like 30-fold.
Yeah, I mean, I think Europe's going to go into a recession on the back of high energy prices. I think most people know that already. I think the ECB, though, the market pricing there looks to me more realistic than it does for the Fed or the BOE, because I think that Europe can actually cope with interest rates at 2%, which is broadly where they're expected to be by the end of 2024. So let's say they go to 3 and then back down to 2. That seems kind of realistic to me.
Okay, so you don't buy euro. I mean, are there any bonds in Europe that could look attractive as long as the ECB stays put?
I mean, I think they're kind of broadly fairly priced. When I look around the UK, Europe, and the US, the potential for more cuts than are priced is in both the US and perhaps to a slightly lesser extent in the UK. But I'd be inclined to be overweight UK and US duration and just neutral in Europe.
Okay, neutral, so there's not an Italy play versus versus bunds or something like that.
It's hard, isn't it? Because spreads haven't widened as much as they sometimes do in recessions. As I say, I think the big question at the moment is ultimately, does everyone know this recession's coming? Almost everyone I speak to does. Listening to your channel, it suggests most people do. So I think, it's probably pretty well priced in, but things like Italian spreads are not pricing it to the extent that they sometimes have.
Okay, if you don't know if a recession's coming, do watch Bloomberg. Mike, thank you so much. Mike Bell there, global market strategist at JP Morgan Asset Management. Coming up, the UK's big chill, power prices hit record levels as freezing temperatures cause a surge in demand. We'll have plenty more on that story next, and this is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing? When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. For the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, tomorrow morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report tomorrow morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK economy grew faster than expected in October. This as businesses recovered output lost following the extra bank holiday for the Queen's funeral. Now, GDP expanded 0.5% month on month. Estimates were for 0.4%. Now, for more on this, but actually the bigger story, which is energy prices, we're joined by Bloomberg's Lizzie Burden. So, Lizzie, not huge surprises in the data.
No, ever so slight gain, beat, I should say, 0.5% month on month in October, driven by retail and wholesale trade. And as you say, the data was sort of muddied by the Queen's funeral, which meant there was a national bank holiday in September. So this is a bounce back from that. It doesn't really move the dial for the Bank of England. However, it is the recession fears that mean we could see a four-way split at the meeting. That's according to Nomura and Bank of America in their notes recently, because you could see the doves like Silvana Tinreiro and Swati Dingra voting for 25 basis points or even no hike at all. And then if you did have a four-way split, it would be Andrew Bailey, the governor, who'd have the deciding vote.
Yeah, and that's interesting because he's kind of been on the fence and saying exactly the way he would vote. Talk to me about energy prices. So yesterday, between 5 and 6 p.m., there was like this crazy hour. We don't have enough wind. And so the megawatt per hour went up by like 2,500 pounds.
Exactly. And that's an all-time high. It's today, later on, that we're expecting to see really strong energy use because we're going to have to heat our homes in this snow. Freezing temperatures really not what you want when people are struggling with their energy bills. But if you can afford to have the heating on, you might want to work from home if you can work from home. It's a really difficult day. So as you say, the EPEX spot exchange for the 5 p.m. hour has cleared an all-time high, more than £2,500 per megawatt hour.
I mean, it's crazy. That's, I think, 45 times the average overall. What does it mean? I mean, we're looking at house prices declining. Like the UK economy seems to be in worse shape than most European economies.
And throw in the strike action that we're seeing, and the government is now considering having to bring in the military and civil servants to cover for the air and seaport workers. There's an emergency meeting of COBRA this morning, which is called when there's a major national disruption or emergency. So it's a very, very difficult moment. The nurses, I should say, in particular, 100,000 of them could go on strike on the 15th or the 20th and the 20th of December. They want almost a 20% pay rise. So it's eye-watering, very, very difficult moment for the government.
Yeah, so we know that, as you're saying, they're drafting in some of the military to deal with the strikes or even border control. How are pay negotiations going with government?
Well, the reason is because the army itself, of course, can't go on strike, so they are the last resort. If you look at it, at this 20% pay rise, the nurses' argument is, you clapped for us, so surely we deserve a real terms pay rise at this moment. But the government has to say, you know, it's pumped billions of pounds into supporting people with their energy bills. It can't, it says, afford to give double-digit pay rises, which would add to inflation. The converse from the unions is to say that there's this gap between public sector wages and private sector wages, about an average of 5% versus 6.8%. And in the public sector, you don't have a wage price spiral because they're not charging higher prices as a result.
So, Lizzie, we mentioned BOE. I mean, Thursday's a big day. We have, of course, ECB and BOE with that possible split vote, giving Andrew Bailey the kind of the final say to unlock it. What does that mean for sterling? Like, how worried are they about the strikes, the energy prices, but also a possible protracted recession in 2023?
Well, it's obviously not a good look for sterling. I would say that the strike action isn't playing into it that much because if you look at the impact of the strikes on GDP, actually, it's marginal. But yes, the recession fears are what's driving the negative outlook for the pound. And this is really what's driving the potential four-way split on the committee. It's Swati Dingra and Silvana Tinreiro thinking, if you're thinking about the 18-month lag in monetary policy, this is when we could be in the depths of a recession. So that's precisely the moment when you're not going to want a big hike taking effect.
Great. Lizzie, thanks so much. Lizzie Burden there, our UK reporter. Now, coming up, there's a change at the top of Maersk. We'll hear from the incoming CEO, Vincent Clerc. That's coming up next, and this is Bloomberg.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Maersk Chief Executive Soren Skou is retiring after 6 years ahead of the company. Now, he will be replaced by Vincent Clerc, the current head of the transport giant's ocean and logistics business. Well, we spoke to Vincent earlier.
After the couple of years of very high demand during the pandemic, we're seeing an inventory correction right now. We had expected that. We see a rapid normalization of freight rates. In the short run, they are likely to possibly undershoot a little bit for a period as our customers actually right now correct inventories and therefore move fewer volumes than what they normally need to from an underlying consumption perspective. So what we're doing here is really a strong focus on our cost base. Strong focus on offering the capacity only that is needed for the volumes that are moving today, and focus also on operational cost, continued focus on operational excellence in order to weather this difficult period. But I think what is important to remember is these inventory correction, they only last for so long. It's about hunkering down, making sure we got our basics in order, and the team is all over it.
Vincent, let me just unpack a little bit of that, because the details around the shipping rates, you said they're likely to kind of remain low for some time. Where does that take you into 2023? How much more downside to shipping rates do you expect to see? And as we face up to these recession risks, what are you seeing in terms of your customers, your clients, in terms of the slowdown in exports and global trade? We saw, for example, the data out of China with their exports looking softer. What are you seeing in terms of the detail on the data?
Yeah, so what we're seeing is clearly a demand going forward in 2023 and 2024 that will not be at the level, at the record level that we have seen in 21 and 22. Partly because demands for some of the commodities that were in especially high demand during the pandemic, like durable goods and so on, this has really abated right now and is normalizing rapidly. Exactly what this means from a demand perspective is hard to say at this stage. We're seeing this unfold. I think we see this inventory correction now. We expect it to last it through probably another few months before we see volume pick up again out of Asia and to align themselves more with what we're seeing as being the underlying consumption. Normalizing of freight prices, as you mentioned, has happened to a large extent, and they have already come to levels that are pretty critical. And we are therefore already taking pretty sizable measures to restrict capacity, to lower our cost base and make sure that we can weather this in the best possible way.
That was Vincent Clerc, the incoming Maersk chief executive. Now let's also get to your Bloomberg First Word News and COVID rapidly spreading through Chinese households and offices after pandemic rules were unexpectedly unwound last week, with hospitals struggling to deal with the surge in cases. Well, scenes of disruption are easily visible in Beijing, where anecdotal evidence suggests that the caseload is many times the government's tally. Now this, as a top medical advisor is quoted saying, the fatality rate from the Omicron variant is actually similar to flu. A major investigation into the bribery of European Parliament officials by an unidentified Gulf nation has led to the arrest of 4 suspects, including a lawmaker. Well, Belgian prosecutors raided multiple properties across Brussels on Friday. Federal judicial police investigators said they suspect a Gulf country of, quote, trying to influence the economic and political decision of the European Parliament. The U.S. will send a delegation to China in the coming days, following up on President Biden's meeting with Xi Jinping last month at the G20 summit. Now, the State Department says the visit is to, quote, continue responsibly managing the competition and to explore potential areas of cooperation. The visit will also prepare for Secretary of State Antony Blinken's planned trip to China earlier next year. And France and Morocco are to face each other in the semifinals of the Football World Cup. The French beat England 2-1 after captain Harry Kane missed a penalty shot that would have brought scores level. Well, Morocco became the first African or Arab team to reach the semis, beating Portugal 1-0 to set up the Mans against France. That will be a pretty hotly anticipated match. Well, that's your First Word News. We're also getting this, we're getting the markets. We always get the markets, but let me bring you up to date with what the markets are doing. Overall, the picture is not great, as we're expecting, of course, traders to be on edge ahead of central banks meeting this week. These stocks are declining at the start of a pivotal week for markets, with interest rate decisions due from the Federal Reserve, European Central Bank, and a host of peers. Coming up, we'll speak with Stanhope Capital Chief Executive Officer Daniel Pinto on creating one of the world's largest independent wealth managers. That interview is next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
light on dark matter, you will make aging optional. Because when you subscribe to Bloomberg, you won't just get news, you will get insight into limitless possibilities. Before you change the world, Bloomberg.
Central bank bonanza. It's a pivotal week for markets with no fewer than 11 meetings, including the Fed, the ECB, and the BOE. Stocks kick off in the red, the dollar up. Power surge. London wakes up to the season's first snowfall as heating demand drives energy prices to records. Meanwhile, the UK also braces for a prolonged series of strikes. And logistics change while the shipping giant Maersk names Vincent Clerc as incoming chief executive, taking over from Soren Skue after 6 years at the top. Shares trade lower. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, speaking of London, the London-based investment firm Stanhope Capital is extending its reach, announcing a merger with Luxembourg-based Arch Associates. Now, the tie-up will actually create one of the world's largest independent wealth managers. And to discuss this story and much more, we can talk to Daniel Pinto. He's chairman and chief executive of Stanhope Capital. Daniel, thank you so much for coming on. And you came on also on such an exciting day, not only for Stanhope, but actually, you know, wealth in general. Is bigger better in asset management when you have, I guess, a confluence of also things that could be concerning for markets?
Not necessarily, but we felt that Luxembourg was a very important marketplace. No. It has benefited greatly from Brexit. A lot of firms have set up shop in Luxembourg. Rather than starting from scratch in Luxembourg, we felt that merging with the top independent wealth manager in Luxembourg was the right move. Arch was created 12 years ago by 3 ex-bankers from Rothschilds. In the space of 10 years, they got to create the most prestigious independent wealth manager, managing about $2.5 billion. No. And we knew them. We had worked with them for a long time because we're managing clients together, and we felt that it was a perfect fit. Right. That's why we decided to merge.
I mean, mergers in any space, but more so for wealth management, are always difficult because of culture, because of different DNA. What do you think your main challenge in putting the groups together will be?
Well, it's to create a platform that serves clients better. I mean, that's the top priority. It's not just about size, in response to your question about bigger, better. It's about being able to offer clients top-of-the-line investment management across asset classes and across the world. And when you are a big bank, you can do that because you have 50,000 employees and they are in all corners of the world. When you're independent wealth managers, it's more difficult. And as a result, we feel that having that strategy of growing organically, but also adding competencies and regions in a very selective way is the way to go. In the case of Luxembourg, they had a specialty in terms of providing family office services to their clients, above and beyond pure wealth management services. We felt that it was very additive to what we're doing for clients. When we made, the merge, when we merged last year with the American firm Forbes Family Trust, which was at the time managing about 11 billion, the spirit was different. It was not about family office services. It was about adding that U.S. expertise to the range of services that we're offering to our clients.
Daniel, overall, are client demands changing because of volatility and because of the new challenges as inflation goes up?
Absolutely. I think that clients are more demanding. I think that clients require more expertise and more depth on the part of their service providers. I think clients are, increasingly interested by a broader array of asset classes. Right. It's not just the, stocks and bonds, the 60-40.
Crypto.
Well, we didn't touch that, but it's no longer the 60-40 portfolio. No. It's about investing in private equity. It's about investing in real estate. It's about investing in alternative assets and doing that in the most professional way possible. Yep. And for firms like Stanhope, it was very important to offer that to our clients.
Do you think the 60-40 will ever come back? And actually, do you worry, private equity, I mean, if we see liquidity concerns in certain parts of the market, including treasuries, what does it mean for liquidity in private equity?
I'm not as concerned as, a lot of people are increasingly concerned about private equity. I think that you might see returns in private equity come down a bit, But come down from where? I mean, the average private equity performance in the world of buyout in the last 20 years has been about 15% per year. That's the average. If it goes to 13%, are investors going to be very disappointed? I don't think so. Okay. So I think it keeps a place in client portfolios. Very important one.
And 60-40, does it come back? I mean, look, what, 12 months ago we're saying it's dead, that's it, bye-bye. And actually in certain parts, it could come back in the next 12 months, maybe?
I'm absolutely convinced it will come back.
Okay.
Not just the 60-40. As I said, it's important to be properly diversified with private equity, etc. The bonds are going to come back. Yeah. I'm not saying I'm bullish on bonds, but bonds are going to come back at the point where we reach peak interest rates in the US, which probably will be in Q1. And I think, you know, in Europe, we are going to reach peak interest rates probably also early next year. At that point in time, investors in bonds will become a bit more interested because the perspective of bonds, of interest rates coming down probably in 2024, not in 23. In 2024, will make it perhaps more palatable to invest in bonds. So I'm not saying to you one should be dogmatically attached to 60-40, but the principle of being properly diversified and having a good portion of your portfolio in equities, but also a good portion in bonds, I think is still very valid.
But Daniel, I mean, peak interest rates, okay, by the Fed, are you actually expecting them to cut? And does it mean that the recession could be protracted but quite shallow, or is it going to be an aggressive recession?
So we expect a shallow recession. We're not in the doomsday camp. We expect it to be a shallow recession. We expect interest rates to peak at 5%, probably by the end of Q1 next year. Maybe a bit less, but probably 5%. And when that happens, I think it will reassure the markets because it will give a direction about what's coming in 2023. They will see that corporate results are not as bad as people predict. You now have a lot of people analysts revising their expectations for corporate earnings next year, coming up with dire scenarios of minus 10% for corporate earnings. We don't believe that.
Mainly energy, right?
Mainly energy. We don't believe that. We feel that corporate earnings are probably going to grow by 3 to 5% in the US next year, which would not be the end of the world, and which would mean that current valuations in the equity markets are not bad, actually. No. We are trading below, in terms of price-earning ratio, market multiple, we are trading below the average of the last 25 years. And even more below in Europe. The US is kind of in line with the average of the last 25 years. In Europe, we're trading on a PE of 11 against an average price-earning ratio of about 14.5 over the last 25 years. Depends what you expect for earnings next year, but we don't believe that it's going to be a catastrophe as many people predict.
So we have Bloomberg Intelligence, and our chief U.S. market strategist came on this morning, and she was basically saying that, I mean, it's a similar scenario, but it would still take, looking at her metrics, 3 years to have a new record on the S&P 500. I mean, that feels like a long time away.
Yeah, you know, I'm very careful about these kind of predictions because people were gung-ho in 2020 and 21 as if markets were going to carry on rising forever, and now they are predicting doomsday. And so these oscillation between extremes, I think, is not, the reality is probably somewhere in the middle. You will not see in the equity markets the kind of performance we saw in 21 and 20, but you might see a high single-digit performance for equity markets next year, and that makes it worth investing in equities next year.
Daniel, we'll get back to markets in a second, but when you look at wealth managers, are there too many? It seems like we used to be overbanked in terms of banks, and now there's just so many wealth management companies. Are you expecting more consolidation?
It seems to me you have too many of the wrong type, which is that you have two extremes in the world of wealth management. One extreme, you have all the big banks that have all the resources in the world, financial and in terms of human resources. But sadly, still a lot of conflicts of interest. They are advising clients, but at the same time selling to them, and that's an issue. That's one extreme. At the other extreme, you have hundreds of independent wealth managers who do not have the conflicts typically, but do not have the resources. What we've done with Stand-Up Capital is to try to take the best of both worlds. Creating a group that has 160 employees, 8 offices, covering the world and covering all asset classes, so resources, but at the same time, being on the side of clients, being properly independent and not having the kind of conflicts of interest that you find in the industry today.
Is this just the first of many M&A deals to come? From how much bigger do you want to be?
I don't think that we are in a rush to buy firms. I mean, that's not the approach. Obviously, we are the obvious consolidator in our space of independent wealth managers, obvious. because we have become one of the largest in the world in our space. But it's not size for the sake of size. As I said, it's size for the sake of serving our clients better.
All right, Daniel, thank you so much. That's very clear. We'll get back to Daniel Pinto and talk a little bit more. Also about the UK, the new regulation. Of course, they're London-based, so how he sees the future of the City of London. Coming up, Chinese officials are further downplaying the risks of COVID-19 as restrictions are eased. We'll look into that story a little bit later in the program. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, last week, the UK set out a package of post-Brexit reforms intended to boost the City of London, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. Now, let's talk to Daniel Pinto. He's Chairman and Chief Executive of Stanhope Capital. And Daniel, thank you so much. First of all, sticking around. You were also, you're a city grandee as a compliment, but you also, 10 years ago, you were telling me, basically looked into or established a think tank looking into regulation for the City of London and what the City of London needs in the future. Like, where are we? Finally, we have a government that's, taking aim at this, but it wasn't the Big Bang 2.0 that we were expecting.
First of all, we are delighted to see the government pay attention again to the city after 10 years of city bashing. I think that the government understands that the city on its own is very important for the UK economy. It's about 8–9% of the country's GDP. It's 600,000 jobs. That's great. But even more importantly, the government understands that you cannot have a flourishing economy without a flourishing city. And they are trying to come up with ways of unleashing this vital energy that you find in the city and in the economy. And regarding the plan that was released at the end of last week, I think there are a couple of things to say. The first one is that there are good aspects, and the best aspect of the plan is trying to make SMEs, small and medium-sized companies, the very center of the UK economy. And you can achieve that both by ensuring that private equity money flows in the direction of growing companies, and by making sure that the public markets remain friendly to these high-growth companies. How did they achieve that? Solvency II, which is a way of relaxing the rules affecting pension funds and insurance companies, enabling them to invest more in green energy, etc. That's great. how did they achieve that as well? With potential reforms to MiFID II, which was, as you know, an EU rule. Some aspects were very positive, other aspects were detrimental. For example, the collateral damage of MiFID II is that research on small and mid-cap stocks kind of died, literally died. And so if we are going to make public markets more welcoming to small and medium-sized companies, we have to make sure that there is equity research provided on these companies. And that's what it's achieving. There are some negative aspects to the plan that came out last week.
Daniel, could they have done more in general? So I want to know about the negatives, but also when you look at, the bonus caps, the call-ins that they haven't done. I mean, these are things, ring fencing could have been done actually 3-4 years ago.
Right. So I slightly disagree with some of the measures that were proposed in that plan, which again had positive aspects, but I disagree with cancelling ring fencing. I think ring fencing was a very good rule. There was a report that came out after the Great Financial Crisis, as you know, the Vickers report, that came up with this proposal of ring fencing the balance sheet of the deposit-taking side of banks and the balance sheet of the riskier investment banking side of banks. That was a very good rule. There is absolutely no reason to come back to it. And I think that probably the government is spending too much time speaking to heads of banks and not enough time speaking to SMEs and independent asset managers, because we would not have proposed this kind of rule. Similarly, cancelling the senior manager regime is a mistake. It was a very good thing to make heads of banks more responsible personally on what the banks are doing.
But sorry, if we go back to ring fencing, and this is an outlier call, I haven't really heard this actually from many people saying that you would have kept the ring fencing. Is it because it puts the smaller, I guess, banks at a disadvantage if the big banks don't have to do? Because I keep on hearing that actually ring fencing wasn't really necessary because of the capital requirements.
I don't agree. I think that ring fencing was a way of preventing banks, big and small, from using deposits to pursue riskier activities. That was an obvious change coming out of the Great Financial Crisis, which, by the way, was triggered by banks. Let's not forget. And I think that, you didn't need to reform that in order to create growth in the UK. You didn't need to do that. The problem, again, with the perception of the city is that the city, in people's mind and in government's mind, is still very much about big banks and FTSE 100 companies. The city is something else. The city should be about SMEs. It should be about everyone. And I think that promoting growth is about paying attention to SMEs and that side of the economy.
Daniel, when you look at, we talk a lot more about Brexit. What does a city become post-Brexit? And are these measures, rightly or wrongly, to try and reverse some of the negative impact of Brexit on the city?
Well, the city has adjusted to Brexit. I think it's water under the bridge. The big companies, the big banks had no issue whatsoever because they already had subsidiaries on the continent. The independent wealth managers typically have expanded on the continent as well. As you know, we have offices in Paris and Luxembourg, etc. So I think Brexit is kind of neutral from that perspective. The one thing about Brexit is that it is creating a bit of a tension, if you will, between the regulators in the UK and in Europe. It's very hard to imagine that we can ignore the regulatory framework in Europe when, in fact, most of our financial services sector is also driven by trade with Europe. So I think we have to find the right middle ground between reforming what can be reformed. I gave you an example, which is MiFID II, but keeping, on the whole, the body of regulation that we had established in conjunction with the EU when we were members of the EU.
So we have to also get back to the markets. You're pretty positive about earnings expectations in the US and think basically the market have gone too far. Does everything rely on whether China successfully reopens? Is this the biggest unknown, and what do you think?
It is one of the unknown, and I don't think the fate of markets rely on that. But it's an important element. I do think that the current government and President Xi understood over the last 2 weeks that there was a turning point, actually, in terms of social peace in China, in the sense of people being locked up for 3 years was not sustainable. And I do think that in spite of the rise in infections in China, they will keep reopening. And I think that it's a positive for GDP growth for next year.
Daniel, thank you so much for coming on. We'll have to get you back on very soon to talk a lot more also about the City of London. Daniel Pinto, their Chairman and Chief Executive of Stanhope Capital. Now let's get straight to your Bloomberg Business Flash. And Microsoft has agreed to buy a stake in the London Stock Exchange Group, giving it a 4% equity holding. Now, the U.S. software giant will will acquire shares held by a consortium made up of Blackstone and Thomson Reuters. The stake is part of a broader 10-year partnership to help the LSE-owned develop, or the LSE owner develop data analytics and cloud infrastructure. Twitter will relaunch its Twitter Blue subscription service on the web on Monday for $8 per month. The company says Apple's iOS users will also get access for $11 per month to subscriber-only features, including the blue check mark. Well, the relaunch of Twitter Blue was suspended in November due to a wave of profile impersonations. And Amgen is said to have agreed to buy Horizon Therapeutics at a valuation of about $26 billion in what would be its biggest ever acquisition. The U.S. biotech giant offer is at a premium to Friday's closing price of about 20%. Potential buyer Sanofi backed out of a deal on Sunday after takeover reports pushed Horizon's market value to $22 billion. That's your Bloomberg Business Flash. Coming up, Beijing asking COVID patients with mild symptoms not to call the medical emergency hotline. So we'll have plenty more on the country's reopening risks. That's coming up next, and this is Bloomberg.
Digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, top Chinese officials continue to downplay the risks of COVID-19 as cities across the country ease restrictions. Well, Bloomberg's Rebecca Chung-Wilkins now joins us. So, Rebecca, what's the latest?
Well, China's top medical advisor sort of emphasizing to people that COVID is just as serious, or no more serious rather, than the flu. And that's been echoed by a lot of state commentary, essentially trying to downplay the severity of the virus and even urging people to stay at home if they don't really have symptoms, to recover and rest at home. But what we're seeing on the streets, and particularly the focus here is on Beijing, is a lot of the disruption and some of that chaos that many countries saw when they first reopened, when they first hit by COVID infection waves. So long queues outside hospitals, people struggling to get access to the medical care and medicine that they need, as well as signs of stockpiling and things like that. So quite a disruptive sign in Beijing. And although the case numbers themselves seem to be dropping, it's really being attributed by most people to a fall in testing, because in actual fact, it does seem like infections are spreading very, very quickly through the capital.
So what's the also potential significance of the China reopening its border with Hong Kong?
Well, I mean, the opening so far as we know it, local media reporting, it would be a sort of pilot scheme that would essentially allow Hong Kong residents to cross back into mainland China. And it would be very, very significant. That border has effectively been shut since February 2020. It's been an extraordinary long time for a border that is normally one of the most porous in the world. Residents typically crossing every day. Back in 2019, there were more than 200 million crossings. So it is sort of really pivotal to the role that Hong Kong itself also plays as this gateway between mainland China and the rest of the world.
Thank you so much, Rebecca Chun-Wilkins there with the very latest on China. In the meantime, stocks are actually dropping. Central banks keep traders on edge. It's certainly a big week for central banks. We not only have the Fed, but we have the ECB and the Bank of England. European stocks declining at the start of a pivotal week, of course, for markets. Interest rate decisions, as I was saying, are due from, I think, 11 central banks overall. Investors looking for firmer clues on how far and how fast central banks will tighten monetary policy from here as recession fears resurface. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons in New York, Anna Edwards here in London. The other thing we're watching out for is, of course, the 24 hours of hike that end the year of fighting inflation. So we're not only looking at the whole week, but it's really 24 hours. The U.S. Federal Reserve on Wednesday set to raise its key rate by 50 basis points. And then a day later, we have the European Central Bank, the Bank of England, likely to follow with half-point moves. Higher borrowing costs are also in the cards with Switzerland, Norway, Mexico, Taiwan, Colombia, and the Philippines. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is a very challenging economic situation here and across the world, and it will get worse before it gets better.
These stagflation problems that we've seen this year, they're not going to go away anytime soon, and there's going to be a nasty inflation sting in the tail with China's reopening.
I think there's a growing coming together that we probably are going to make more progress on inflation than many people expected, but it's because the Fed is going to do what's necessary.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Focus on the Fed. The central bank is expected to downshift this week on interest rate hikes, but inflation data out Tuesday could complicate matters. Power prices in the UK jump to a record. Freezing temperatures cause a surge in demand, while a drop in wind generation leads to a supply crunch. And two multi-billion-dollar deals making news. Bloomberg's learned that Amgen has agreed to buy Horizon Therapeutics at a $26 billion valuation. Meanwhile, Microsoft is taking a stake in the London Stock Exchange Group. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it really is a busy, busy week to bring almost to a close this year.
Yeah, I think we might be able to call the year over by the end of this week once we've gotten the rate decisions from the Fed, the ECB, the BOE, and of course we've already gotten that inflation print coming up tomorrow. So it's a lot for the market to consider. In Asia, they also are considering, on top of all of that, the trajectory of COVID and COVID restrictions in China. Of course, we have seen an easing of those restrictions, but the result of that is that cases are surging and leading unprepared hospitals to be in a bit of a difficult position in China. So that really seemed to drag on risk sentiment in Asia overnight. The MSCI Asia Pacific Index as a whole down about 0.9%, but it was Chinese stocks listed in Hong Kong that really underperformed. They were down by about 3%. At the same time, in foreign exchange, the Chinese yuan is weaker against the US dollar. Still, we're sub 7 on offshore yuan to the dollar, 697.56 where we trade at the moment. But again, that is a little weaker on the day. And then, of course, in the bond market, that is really where you see traders trying to grapple with and anticipate what we are going to see over the course of this week from 11 central banks making decisions. And we did see upward pressure on yields in the Asia Pacific overnight. In Australia, that 10-year yield up about 9 basis points to 338, Matt.
All right, that's interesting. Yields coming down here in the U.S. and pretty much everybody is bullish on the bond market, with the exception of Wells Fargo. Eric Nelson was on from Wells Fargo with John Farrow on the Open Friday, and he said he sees yields going to between 425 and 475. Now, that's contrarian. Everybody else on the street thinks that pretty much everyone else thinks that we've hit a peak already in yields with the 4.25 that we saw last month or 2 months ago now. Today we're trading down a little bit to 350, 397 as investors buy this debt. Investors are also buying U.S. futures right now up just about 0.2%, but the trend is up. If you look at a graph of futures, you'll see the curve goes up and to the right. So 39.74 is what we're looking at there after we finished the week down last week. And then, speaking of down, NYMEX crude off another % today to 69 cents, down to $70.33 a barrel. It's the lowest level we've seen on crude since I think, December 20th of 2021. So it's been almost a full year since we've seen a drop this, or a level this low, I should say, on oil, which is interesting if China's reopening. It does look like the world is, or investors are more concerned about a global recession. Bitcoin right now down at 0.9%, but still a little changed around 17,000 as we've been seeing for the last few sessions, 16,961, so continues to hold steady. Anna, what do you see in Europe?
Yeah, more on crypto later in the hour then, Matt. This is the picture in Europe, and actually, I mean, it's negative, but it's better than it was. To Matt's point there about how futures are trending higher for US equity markets, well, the same is true of the European session. As those US futures recover a little bit, we are seeing that help Europe to gain a little away from earlier lows at least. So the FTSE 100 down just 0.1%, the CAC 40 almost flat, the DAX down 0.1%. That said, all sectors are still in negative territory here in Europe, so it is pretty broad-based, but we're really trying to play catch-up with Wall Street. That late sell-off we saw on Friday as a result of the PPI data just spooking investors a little bit, setting us up this week for the CPI. More on that in a moment. It really is a busy week ahead. Let's have a look at some of the assets we picked out from Europe to mention today. Matt was talking about WTI. The same applies here on Brent, 75.29, down another 1%. This is one of the sectors in Europe that is in negative territory today, the energy space. So energy producing companies trading lower today, partly because of this move lower in the oil price. And to Matt's point, maybe recession fears are dominating thinking rather than the reopening themes around China. The pound at 122.81. It has recovered a lot from that 103 level, but it is possibly going to be a volatile week. We have a Bank of England meeting this week. We have a lot of central bank meetings this week, some 11 in fact. Could we see a four-way split at the Bank of England? Could there be votes for hold, for 25, for 50, and for 75 from those 9 policymakers? That is the question. London Stock Exchange Group, then, that stock up by 3.7% as Microsoft takes a 4% stake. Of course, LSE Group now owns Refinitiv, which competes in some places with the owner of Bloomberg Media, so we should mention that. But interesting to see as it is increasingly a data company doing this kind of deal, and board members from Microsoft going onto the board at London Stock Exchange Group. This is Christian Hansen, which is a specialty chemicals business, up by 20% in Denmark on this M&A Monday, as we see the enzymes business that is Novozymes, another Danish business, coming in to buy it. Are they paying too much? That is the concern that Credit Suisse has, and that is reflected in the Novozymes share price, which is substantially weaker, Matt.
All right, so a heck of a lot going on in markets, and it's not even 5:15 on a Monday morning. A big week lies ahead for the world's biggest central banks. Rate decisions are due from the Federal Reserve, the European Central Bank, and the Bank of England. The Fed decision on Wednesday is coming after crucial U.S. inflation data, the CPI, that's due out tomorrow. Joining us now for more is Valerie Teitel, our markets reporter. So, Valerie, what will drive markets this week?
Hey, Matt, good morning to you. Okay, I've got 3 things which I think are going to be key for this week, and it's all the data coming out of the U.S. and the Fed. First, it's CPI. I really am interested in this core services ex-housing component, because in the last speech we heard from Powell, he took inflation and broke it down into 3 parts. It's goods, it's housing, and then it's core services ex-housing. He said that we had progress on the first 2, but said that this one is a little bit more muddled. And more importantly, this is the most important driver of inflation going forward. So on Tuesday, I'm really going to be looking at that component. Next is the Fed's SEP. This is their summary of economic projections. This includes their forecasts for unemployment and for rates. I'm really going to be focused on the 2023 dot. This is what most people think is where the Fed is trying to guide us on the terminal rate for next year. It was 4.6 at the last meeting. He told us it's headed higher in his last press conference. But how much higher? 5, 5.25, 5.5? What are we looking at? The market is currently pricing around 5. I think any shock about 5.25, 5.5 will really turn the equity market sour. Lastly, any comment on the loosening of financial conditions from Powell? This was notably absent in his Brookings speech. He really failed to push back on the equity market rally, especially that we've seen since the bottom just a few months ago. And in my next chart, I want to show what the S&P is battling with here. It's really having a tough time cracking the 200-day moving average. This is something that it really failed to test during the last pivot mania craze and bear market rally. But look, We had some decent analysis on the Bloomberg terminal today that said in the last the last 6 CPI prints, the S&P has moved an average of 3%. We are just 3% shy of the 200-day moving average, so we could really, I mean, if it comes in soft, we could really end the year above this mark, which I think would be key for driving risk into next year.
Okay, Valerie, thank you very much. Bloomberg's Valerie Teitel. I'm taking notes. 3 very important points to watch when it comes to the data and the Fed later on this week. Now, rare snow covering London this morning with the Arctic weather testing Europe's resiliency during the energy crisis. Well done if you got into the office this morning. Well done if you've got your at-home setup sufficient that you didn't need to battle with the weather. But UK power prices jumped to record levels, but Europe's natural gas prices have actually slumped this morning. Joining us to discuss all that's going on in energy markets, Rachel Morrison is with us from here at Bloomberg. Rachel, good to have you with us. So is the UK going to have enough power tonight? That's one of the questions that markets, I suppose, have right now.
Yes, looking at this evening from about 5 p.m. during what we call the tea time peak, the supplies do look quite short, which is why National Grid has asked a reserve of coal-fired power stations to get ready to generate this evening. So that's one of the tools that they knew that they needed to have ready for this winter. And because it's cold, as you mentioned, demand is spiking, and because wind generation is almost nothing, it looks as though National Grid does need to use some of those tools that it has to make sure that the market is balanced and that we'll be able to keep the lights on this evening. They say it's looking okay. They've got everything that they need, but prices are extremely high for this evening. So the market is obviously still seeing that there's a bit of a problem.
Well, of course, to achieve that balance, Rachel, it's not just about bringing demand down. You also, in theory, would like to see supply moving higher. When will this supply crunch end?
Well, we know that the wind is going to pick up, possibly tomorrow and then throughout the week. But the weather's going to still stay cold, so we're still going to have a lot of demand. But even with a bit of a pickup in wind, I mean, it really is extraordinarily still here today. That will help the situation. So we do think it's mainly tonight, this evening, and then the situation improves. However, there could be more incidents like this throughout the winter. At the same time when the weather's cold and the wind drops. That's the kind of bad combination.
All right. Thanks very much for that, Rachel Morrison. There joining us on the telephone, talking to us about energy prices, which are expected at tea time today in London to hit an all-time high. Now, in deals news, Bloomberg's learned Amgen has agreed to buy Horizon Therapeutics at a valuation of about $26 billion. If approved, this would be the American biopharma company's largest ever acquisition in a difficult market for deals. Aaron Kirschfeld, Bloomberg executive editor for Global Deals, joins us now. So a lot of M&A news to kick off the week, Aaron, and this $26 billion deal is a big one.
Indeed. I mean, we were preparing for the snow and strikes this week and thinking we could focus on that, but actually we were extremely busy on the deals front. We knew that the Horizon Therapeutics sale was coming to a head, that it was down to Amgen and Sanofi, the French drug maker. But in a surprise announcement, Sanofi announced that it was dropping, and that left the door open for Amgen to seal a deal. And now our sources have been telling us and other media that they're nearing an agreement, could be announced as early today, and it's a whopping $26 billion deal.
Yeah, and a nice 20% premium to the closing price of Friday for Horizon, which is up about 13.6% in pre-market trading this morning. And of course, it's not just that merger or deal on this Monday we have to pay attention to. There's another one, Microsoft agreeing to a 4% stake in the London Stock Exchange. What can you tell us about that?
Yeah, when I saw that headline, I had a bit of a heart attack because I thought, oh, is Microsoft buying LSE? But actually, they're just in quotation marks buying a stake still, $2 billion investment. And I think it's more about a cloud partnership. They're looking to team up as LSE, as mentioned before, is kind of building out its data analytics, its cloud presence. So Microsoft, as kind of the long-term partner, will invest. So it shows, obviously, the two will be working very closely going forward. And it was one of, I'd say, almost half a dozen deals announced this Monday.
Yeah, absolutely. A lot to keep us busy on this Merger Monday, then. To keep you busy, certainly. Aaron, thank you very much. Aaron Kirschfeld, Bloomberg's executive editor for Global Deals, with the latest on a range of sectors there. Coming up on this program, we'll talk to Christian Keller, head of economics research at Barclays. How is he approaching this critical week ahead? And on crypto, Reeve Collins joins us, former co-founder and CEO of Tether, who's now co-founder of Smart Media Technologies. We will talk about what we can expect from the Sam Bankman-Fried testimony about where stablecoins go from here. Plus, Ghosn's daring escape cost his extraction crew their freedom. Read more about the father and son team in today's Big Take story. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. A big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, tomorrow morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report tomorrow morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. We are looking at a fading S&P 500 premium over the 10-year yield. The earnings yield minus the 10-year yield falling here. Now, it's interesting. We heard Wells Fargo last week forecasting a possible 475 on the 10-year. That is, of course, a big outlier in terms of forecasts on the street. And pretty much every strategist has come out and said earnings are going to get hit, even if we don't go into a recession. David Kostin from Goldman Sachs says the margins are going to get hit next year, so earnings expectations need to come down. Joining us to talk about this, Ven Ram is Bloomberg cross-asset strategist. Ven, it seems like every strategist we look at is coming out with a note saying we're going to come down to 36, 35, 3,400 at the end of the first half and then bounce back to 4,000 or 4,000 and more at the end of next year. What are you hearing?
Morning, Matt. I agree with the initial part of what these strategists are saying, that, you know, it's going to fall down to 3,000 plus, around 3,000 levels, because at the moment, the markets are 95% optimism and 5% realism. And I think that that paradigm has got to shift. I mean, the Fed is going to keep going on rates because, okay, the economy is going to slow. Yes, we know that. But what we don't know is how much inflation is going to come down by. Yes, inflation may slow, but is it going to slow to 2%? That the Fed is going to take its foot off the pedal and say, okay, let's accommodate the markets now. I don't see that happening, and therefore I think that stocks have more room to fall.
Okay, so you think we're too optimistic on stocks. Good to see you, Ven. Let me ask you about the trade-off then between stocks and bonds. I spoke to the CIO at Coutts earlier on, Alan Higgins, who was saying to me, yes, he can see arguments why people are saying, therefore, you get into bonds. But he says maybe there's going to be limited appetite for bonds when they yield what the 10-year is 3.53%, when you compare that to what you get on cash right now.
Absolutely, and I think that there is a case to be made for bonds, but I do think that you want to make a case for bonds at the front end, because if you look at the 2-year yield, you don't take too much of a duration risk, and you're getting a pretty decent yield. Of course, the 2-year maturity has got a bit more to sell off, but I think we are kind of reaching approaching the top. So that is on fixed income, it comes down to how we are positioned and where on the curve we are positioned.
And finally, then, in foreign exchange, what about the dollar?
Morning, Kelly. I think that the dollar is kind of done its peak for the year. I think if you look at the Dixie index, we approach 114 plus levels. I don't think we are going to reclaim those levels, simply because if you look at inflation-adjusted yields in the US, I don't think we are going back to those peaks unless the Fed does a second round of increases next year, which, based on the baseline scenario, is not the central case.
Okay, well, we'll see with the step down this week. That's what's anticipated if they deliver that and what comes with it, what language. Ven, thank you very much. Ven Ram joining us there with the latest on, well, in that case, stock markets, bond markets, the dollar, a host of assets. For more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog, hotly debating moves in markets. This is Bloomberg.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
You've got to explain this one to me.
What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. A man charged in the 1988 Lockerbie bombing of a Boeing 747 that killed 270 people is in U.S. custody. He's been identified as a former Libyan intelligence officer. The U.S. calls the suspect a third conspirator in the attack, saying he helped build the bomb that destroyed Pan Am Flight 103 over Scotland. In China, COVID is rapidly spreading through households and offices after the country's pandemic rules were eased. That's led to turmoil in poorly prepared hospitals. Some facilities are struggling to find enough staff, and others are suspending non-COVID treatments. Germany's Chancellor Olaf Scholz will host a virtual meeting of the Group of 7 leaders today to discuss Ukraine's immediate needs. That's following Russian missile attacks on the country's energy infrastructure. Meanwhile, President Biden spoke to Ukraine's President Volodymyr Zelensky. The White House says the president affirmed the U.S. commitment to keep providing military and economic aid. It's a change at the top of one of the world's largest shipping companies. The CEO of AP Moller-Maersk, Soren Skoo, is stepping down. He'll be replaced on January 1st by Vincent Clerc, the head of Maersk's ocean and logistics business. Clerc is taking over at a time when freight rates are drastically falling. And in the UK, the government is planning for military staff and civil servants to cover for striking rail, health, postal, and other workers. Strikes are planned for almost every day through the rest of the month. Workers are demanding pay hikes that keep up with inflation. It's the biggest wave of industrial strife in the UK since the 1980s. And of course, you put together the strikes with the current weather situation you are dealing with, Anna, and energy costs that are shooting higher. It is a very complicated equation for the UK economy, especially for the Bank of England as they look ahead to their meeting later on this week.
Yeah, so many uncertainties. I mean, I mentioned I spoke earlier to the CIO of Coutts, Matt, and he was certainly saying there could be a lot of volatility around the pound this week because of this lack of visibility about the UK. I mean, the cost of living crisis means there's an emphasis on the downside risks for the UK economy, but we still have double-digit inflation, of course, and many people think that that will remain for a little while. So could we see this four-way split then at the BOE? Will be interesting.
And you know, double-digit inflation that nurses have to pay in order to deal with their daily lives. If anybody needs a raise, if anyone deserves a raise, especially after what we've just gone through, isn't it the nurses? I don't want to get too editorial here, but you know.
There was a phenomenon around COVID where every Thursday night in the UK, people went onto their doorsteps to clap for those who work for the National Health Service, as sort of coming together, if you like, at a time of need. And so, yeah, a lot of the services saying, if you clap for us, now you need to pay us. That's their argument. Of course, the government has other arguments to make around.
Well, they were chronically underpaid to begin with,
not making the inflation services, the inflation any worse, and being good custodians of the public purse. We will talk macroeconomics with Christian Keller shortly. This is Bloomberg.
we've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Focus on the Fed. The central bank is expected to downshift this week on interest rate hikes. But inflation data out Tuesday could complicate matters. Power prices in the UK jump to a record. Freezing temperatures cause a surge in demand, while a drop in wind generation leads to a supply crunch. And two multi-billion-dollar deals making news. Bloomberg's learned that Amgen has agreed to buy Horizon Therapeutics at a $26 billion valuation. Meanwhile, Microsoft is taking a stake in the London Stock Exchange Group. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, we can talk about where futures are this morning, jumping a little, incidentally, from the weakness of Friday. But really, it's a focus on the middle of the week, the data and the central banking decisions still to come.
Yeah, absolutely. I mean, we get CPI out tomorrow, and as Valerie Teitel was telling us at the top of the show, over the last 6 CPI releases, we've seen the market move 3% or more. So it does look like we're seeing a little bit of a gain in futures right now, but there's a lot going on, and no doubt you'll see lower volume until you get that CPI release out, and then again until you get the Fed decision on the next day. Right now, the 10-year yield is coming down a little bit as investors buy the treasuries. Right now, 350, 342 is the level. I keep mentioning we've gone to 4.25 just about 2 months ago, and most strategists on the street are betting that investors are going to buy treasuries, and the yields have spiked. NYMEX crude right now is off about 0.6%, $70.61 a barrel. It's the lowest level we've seen since December 20th of 2021, so almost a year since we've seen levels this low, and that speaks to the bearishness in terms of the forecast for the economy, the global economy, really not being helped by the reopening in China that we're seeing. And then Bitcoin right now off 0.75%, $16,981, but it's been hovering around 17,000 for the past few sessions, climbing up a bit from the $16,000 level since the collapse of FTX. Kaylee, what do you see in the pre-market?
Well, it is a merger Monday, and Anna was mentioning some of this in the headlines, but one of the big stories of today is Amgen buying Horizon Therapeutics with about a 20% premium compared to Horizon's closing price on Friday, $116.50 a share. That is equivalent to roughly $26 billion. And as a result, that stock is up about 12%, trading at 109 right now. Amgen, for its part, a little bit lower, down about 0.5%. But of course, that would be its biggest deal ever. Now, another deal, though it isn't an outright acquisition, is a 4% stake bought by Microsoft in the London Stock Exchange Group. Microsoft shares up about 0.3%. And I know Anna will have the update on LSE as well. One deal, though, not happening. Rivian is abandoning its joint venture to make electric vans with Mercedes-Benz in Europe. They're they're instead going to focus more on their own consumer and commercial vehicles. So as a result of abandoning that pact that was signed only 3 months ago, Rivian shares are down about 4% before the bell, Anna.
Kaylee, European equity markets then under a little bit of pressure this morning, down by 0.4%, playing catch up with Wall Street at Friday, though, as we see US futures looking a little bit more buoyant, as Matt just pointed out. Brent crude is down by 0.6%, 75 now the handle on that oil price. Our colleagues on the Markets Live blog talking about how the Kremlin's response to the cap that we've seen agreed, certainly at European level, G7 leaders discussing as well. The Kremlin response to that, certainly something that we'll still need to watch out for, also pointing to the possibility of short covering happening on oil prices. That's got to be a risk to the upside, according to our colleagues on the Markets Live blog. 122.76 on the pound. Just putting this one in there because we do, of course, have the Fed meeting, but we also have the Bank of England meeting, and there's so much uncertainty about the path ahead for the UK economy. Just what does the Bank of England decide is going to be something to watch later on. And as Kaylee was referencing the Microsoft share price, here we have the London Stock Exchange Group and Microsoft taking a 4% stake in this business. It is, of course, a trading business. It's also very much a data business now after that Refinitiv deal was finally done last year then, Kaylee. And as a result of that, Microsoft and LSE Group doing some interesting stuff around cloud and artificial intelligence. And in fact, their AI and cloud boss at Microsoft will now sit on the board of the London Stock Exchange Group.
Yeah, Anna, so some very interesting micro stories on this Monday in a week that is largely going to be dominated by the macro, including the Federal Reserve, which will announce its final rate decision of the year on Wednesday. Ahead of that, we asked a few of our guests their thoughts about the strength of the U.S. economy.
I feel that right now things are going in the wrong direction. Yeah. We're entering a recession in most advanced economies, starting with the United Kingdom and the Eurozone, also in the United States soon enough. And inflation is still too high. So we're entering a stagflation like we're not seen since the 1970s.
I think it's premature to say that there is a Fed pivot. I mean, we saw another 100 basis points of Fed tightening to go. And then the question is it a pause? Is it really something that I would call a high hold, not a pivot? And I do think that that's really more of the scenario that we see with recessionary risk in the U.S. rising towards the end of 2023.
Those are the aspects which I guess all the policymakers are trying to address. And over the next 6 to 12 months, I think that conundrum is probably going to be a bit more pronounced if Fed rates go higher and stay higher.
I don't think we're going back to the last 10 years that we had of acute financial repression. So I do think you'll have a more normal interest rate environment going forwards.
These long forward rates are assuming that, 2+ years from now, a 2.5% Fed funds rate is in the bag. It is going back down for sure. Hey, that's a possibility, but I think that's highly overrated.
Joining us now to discuss the Fed further is Christian Keller, Barclays Head of Economics Research. So, Christian, we're all basically anticipating a 50 basis point hike come Wednesday. The question is going to be surrounding the dot plot. What do you expect to see?
Exactly. I think, there's pretty much certainty that the Fed, but also the ECB and the Bank of England will go to 50 basis points increments. What we expect, though, in the dot plot and also in the communication, that the Fed will make clear that, the 4.6 median dot plot that they saw as a terminal rate in September is not enough. We think they'll put it probably to 5.1 or so by the end of 23, signaling very clearly to the market that they don't like really that the market is already pricing cuts for the second half of next year.
Okay, so that's what you expect to see around the terminal rate then for September 2023, taking it up then from 4.6 to something 5.1. Christian, what about financial conditions? Our colleague Valerie was earlier talking about how, financial conditions are actually pretty loose. The Bloomberg gauge shows conditions looser than when the Fed first started hiking, which is quite incredible given the amount of hiking that we have seen. Yeah. How much pushback against that do you think the Fed will give us?
Yeah, I think quite significant. I've called this a lot the pivot paradox, because there's a certain reflexivity here. By markets anticipating the pivot and then relaxing financial conditions, which they can. The Fed obviously has only control of the short-term policy rate. They can't control what happens to equity pricing. They can't control what happens to credit spreads. And those all have loosened. And, as you said, most indicators of financial conditions are back to where they were quite some time ago. In the meantime, the Fed has hiked, and the Fed will try to push back. They have to be careful. They don't want to outright be seen as trying to, bring markets down. But I think there'll be a lot of language on caution, on, that this is, they're going to continue to hike into 23, that they're not envisaging cutting soon, and they will hope that the market will take this for real.
And how does the China story weigh in here then, Christian? If we're looking at what the Fed is going to be doing this week and the narrative they'll give us for next year, I suppose a lot of people trying to assess how choppy the reopening story in China is going to be, how stop-start, and therefore what it's going to do to commodity prices. How are you factoring all of that in?
Yeah, that's a very good question. I think the market has been quick in repricing some of the equities in China, but it's not clear yet whether the market has really reacted to the potential reopening of China, because we had a very weak Chinese economy. Even the data we are seeing coming in now points to a very weak fourth quarter. Now, last week's pivot, if you want to call it that way, the COVID policy pivot by China is quite decisive. If China really opens earlier than expected and more forceful than expected, we think that could actually, not only lead to better growth, be welcome probably, particularly from Europe, to have a stronger export market again, but it would probably have an impact on energy. Remember that oil demand and natural gas demand by China was fairly weak over the last year or so. And if China opens up, in particular, transportation will demand more oil, and also the natural gas that in large part has been actually redirected towards Europe. If China needs this, you would expect that the market becomes tighter there again.
Yeah, I mean, doesn't it strike you as odd that we're seeing $70 barrels of oil here in the U.S.? I guess 75 for the global benchmark Brent. But at the same time, we're going to see, 100 million people filling their tanks up again within a couple months?
Yeah, look, the oil market is driven by so many forces. And, as a macroeconomist, I've given up trying to understand every move in the sense that, there's a lot of the supply issues and, and inventories, etc. I may not fully grasp at any moment of the oil market, but I think the tendency from here, if we see China coming back and the winter basically having also just started here in Europe, it's much colder than it was just a few weeks ago, you would think that the tendency of oil should be going higher, in particular because the recession in the US seems to be not imminent. We see it coming in 23, but we just pushed it back actually to the second quarter. And so far, the US economy is also holding up quite well.
What do you think about the possibility of a real structural shift in the oil markets and global currency markets? I mean, if the Saudis start to sell a lot more oil to the Chinese priced in yuan, or, Zoltan Pozsar said it's unlikely, but if Putin decides to start charging, a gram of gold for a couple barrels of oil instead of dollars, would one of those things, you think, potentially really come to fruition?
Yeah, it's an interesting question. I mean, there's been a long debate of what, the dollar loses its primacy, not only a reserve currency, but also as the main currency in which basically all the commodities in the world are being traded. I don't see this coming yet. We have been quite skeptical of these announcements. But, look, over time, there is certainly something has happened. As you mentioned, the connectivity between energy, oil, and natural gas being produced in the Middle East, and Asia being, the main demand. Those things could have an impact. There would be more and more people wondering, why do we still price all this in dollar? But frankly, I don't think it's a near-term change, maybe a longer-term structural change. But frankly, I think we're still a bit away from that.
Christian, thanks so much for your time. Christian Keller joining us there from Barclays. We will have a conversation about crypto shortly. On the crypto front, Reeve Collins will join us, former co-founder and CEO of Tether, who's now co-founder of Smart Media Technologies. We will talk about what we're going to hear from Sam Bankman-Fried this week, that testimony. That'll be certainly one focus for the markets. Where do stablecoins head next then? This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, FTX founder Sam Bankman-Fried is set to appear in the House tomorrow to testify about the collapse of his crypto empire. In a series of tweets, he said he would be limited in what he could tell the panel because he doesn't have access to all of his data. Joining us now for more on this is Reeve Collins. He's a former co-founder and CEO of Tether, who's now the co-founder of Smart Media Technologies. And Reeve, it's great to get some time with you. Let me first get your overview. What do you think happened at FTX that Sam Bankman-Fried is either unaware of or not telling us?
Well, I really doubt that he's unaware of much that took place. It did grow really quickly. However, he was the CEO and maintained a really tight grip on everything that took place at both FTX and then I believe Alameda as well. So I don't think that he can plead ignorance on any of these charges.
So in that case, I mean, do you think there was commingling of funds going on? That seems to be pretty apparent. Was it fraud? I mean, I hate to make that kind of allegation without evidence, but I just wonder what your take is, since we've gotten the takes of pretty much everybody.
Yes, there's absolutely was commingling of funds, and now people are trying to determine how much SBF really knew. But at the end of the day, it doesn't matter. He was the CEO, so he either committed gross negligence or fraud. And at this level, either one should end him up in jail. He damaged over 1 million people, and he has to pay for that because he's ultimately responsible for everything that took place there.
Well, and it could not just mean repercussions for Sam Bankman-Fried himself, but the crypto industry as a whole, as we now have the focus of regulators and lawmakers renewed on this. How do you expect the tone to shift? What do you expect to hear in these hearings tomorrow, especially as there already has been effort to legislate crypto and stable coins as well, which goes back to Tether, that has struggled to see real finite progress? I mean, how do you expect things to change?
Well, tomorrow's going to be really interesting. So Sam's been on this apology tour for these last few weeks and really trying to win the hearts of the public. And we all feel that it's against the advice of his attorneys because he should just be quiet. But he's just facing potentially life in prison. So he's doing whatever he can to get people on his side, but I just don't think it's going to be successful. The media has been treating him for the most part very kindly, which is a big surprise. So we're hoping that after tomorrow, things shift a little bit and he ends up really feeling the heat and the pressure that's upon him because he really owes both the crypto industry and the general public a significant, not only apology, but he needs to pay for what took place.
Okay, so that is on his side, on the side of the parties that will be questioning him and potentially trying to make changes to laws as a result of this to avoid something like this happening again in the future. What should the composition of those changes look like, be it regulatory or legislative?
Yes, we do believe that there'll be a lot more regulatory oversight coming. And this has been a bipartisan issue. So even no matter what's been taking place in the House and the Senate, we feel that there will be more people leaning in. And a lot of the people in government are doing their best to be more educated and legislate responsibly. Unfortunately, actions like this will force legislation much quicker, so it might be broader reach than it needs to be. However, everyone's demanding some changes, which we do believe will be coming soon.
Reeve, good to see you. You obviously have your views on what happened here, talking about the possibility of gross negligence or fraud. These are obviously fairly serious things to allege that somebody has done. We'll wait for the legal process, of course, to run its course. But for you, then, is there evidence of those things? What is the best evidence that you've seen or read to make such a firm statement?
Well, for me, it's just my personal opinion that as the CEO, he is responsible for what took place. He can't claim ignorance. He can't claim poor management. And if he does claim poor management and ignorance, that's gross negligence. So he does need to hold himself responsible and his team. It is well known that he didn't have a CFO. How can you have an exchange of that size with no CFO? It's also quite surprising that these massive venture capital firms put in so much money and did all of this due diligence and with facts like that staring them in the face, and they still gave him the money. It's just, time will tell and more stuff is going to come out. But at this point, it just all fingers point to him.
Okay, well, we'll wait to see what those facts are then. As the co-founder of Smart Media Technologies, I mean, clearly the whole crypto space has really been shaken by this story, and to some extent it's reflected badly on other players in the sector, or at least raised ongoing questions about the sector. Is that something that you as a business have noticed? Is there less enthusiasm from infrastructure, from big players in the financial space to get more involved in crypto?
Right now, everyone's taking a much more cautious approach and sitting on the sidelines for a little while. So that is being seen across the industry, especially at the exchanges. However, the technology continues to be built. This technology is only 10 years old. It took the internet 26 years from 1969 to 75 before it got some real commercial applications. So the technology is still being built. People still realize the impact it will have, and the ease of use, more regulation, and more applications are going to be built soon. And so more people around the world will feel what this technology can deliver. So that's what's being taken place right now. People are heads down and building.
I wonder about, your involvement with Tether. It's been an amazing run there. It's the most traded cryptocurrency on earth. At the same time, Coinbase came out last week and said they'll waive fees for anyone who wants to convert Tether to USDC, implying that it's a safer technology. What do you say to the people who are concerned about a lack of transparency at Tether and who don't know which assets are backing their dollars there?
Well, it's an excellent question. And I believe what Circle or Coinbase did, because USDC is a joint venture between Circle and Coinbase. And this is just a purely competitive move. They're now marketing that their token is safer with no real proof or anything, but it is a marketing statement. And now there's free trades amongst, if you want to transfer your money from Tether to Circle. Tether to USDC. I don't believe that that's going to have much of an impact because those fees are pretty minimal. And so at the end of the day, people use these tokens for their utility, and all the stable coins, especially Tether and USDC, really provide tons of utility within the ecosystem and within cryptocurrency. So this is just simply trying to gain market share, going from the 46 billion and trying to shrink the gap between Tether's 69
for
billion.
sure. But Reeve, it seems like Tether gets more and more transparent throughout its life, but doesn't ever share everything, right? Why wouldn't you just put everyone's mind at rest and just or why wouldn't Tether just put up, an actual live real-time accounting of all the assets backing the Tether out there?
I really do believe the principals are doing their best possible job and able to be as transparent as possible. They do have audits on their website, and it seems that the industry at times doesn't feel that's enough. I don't know how much more in-depth they'll need to go to alleviate all the naysayers, but it has withstood this test of time.
All right, Reeve, we have to leave it there, but thanks so much for joining us. That's Reeve Collins of Smart Media Technologies and the co-founder of Tether. And for more crypto conversation, make sure to tune into Bloomberg Crypto tomorrow. That's Tuesday, as the FTX hearings get underway. Join us at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Let's take a quick look at what is ahead in a busy week. Tomorrow, we will be getting U.S. CPI for November, plus central bank bonanza. On Wednesday, it's the decision for the Federal Reserve. Then on Thursday, we'll get decisions from the ECB and Bank of England. And finally, on Friday, it's the deadline for a new funding deal to avert a federal government shutdown here in the U.S. So, Anna, Matt, everybody else, buckle up.
Yeah, buckle up. I'm tired already. It's only Monday. It's barely 6 o'clock in New York. That is it for Early Edition. Surveillance is ahead. They'll be hearing from Laurie Calvasino, amongst others. This is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct to consumer. Like I want to build out a true consumer empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
The Fed doesn't want to actually grasp the nettle and tighten financial conditions.
We've got them going 50 now in December, 50 in February, and another 25 in March.
We think that next year what we're going to see is a Fed that's continuing to tighten.
The biggest risk is if they under-tighten, because they've sent such a strong message about needing to get inflation down.
These stagflation problems that we've seen this year, they're not going to go away anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Why is your bracket so good?
Oh, please.
I mean, seriously, how is your bracket that good?
Here's the way it is, folks, and we do it from March Madness as well. Kaylee Lines taught me this. She only goes with, like, Netherlands and the others that have orange in their jersey, like the Cavaliers.
You chose blue.
Blue. It's a blue theme this year.
So you've got a France-Argentina final.
France-Argentina in the final.
That is absolutely
very
ridiculous.
sophisticated.
I promise this is going to be a refuge for English football fans for the next couple of hours. We're just not going to talk about it. Live from New York City this morning. Good morning. Good morning. Your equity market positive by about 0.25% on the S&P 500. This week, TK, we're told it's all about two things.
Well, it's a huge week. Inflation, and we're going to get that survey, and then, of course, we have a Fed meeting. Join us for that, folks. We'll be there on Wednesday, I think it is. And John, what's important to me is to see if Powell can keep the ball contained in the goal and not put it over the crossbar.
You're going to keep digging, aren't you?
I'm going to keep going on that. And the answer is I think he's going to be very contained. He's going to be very on message. And because of that, I'm looking far more at the inflation data.
Mike Wilson, Morgan Stanley, yesterday's news. He knows how to make a headline over at Morgan Stanley, doesn't he? Mike says yesterday's news, the final chapter of this bear market is all about the path of earnings estimates, which he says are far too high.
And I got on Twitter this weekend. The Zeitgeist was really busy this weekend, folks. And somebody said, you know, he's got to be the #1 strategist of the years. And he's not, because he's too nice a guy. What the street likes.
You're saying you've got to be mean?
You got to, not mean, but you got to go, we believe.
We believe.
We believe.
We believe.
Lori Calvasina's like Mike Wilson. You know, they have grace and dignity, and he's got humility, and he nailed it this year.
Do you know what everyone believes? That we get this dip and then a rip next year. Dip and rip. I keep saying that. We're going to get this downdraft where we retest the lows of last year off the back of weak earnings in the first half, and then, Tom, it's all going to recover, and we're going back to 4K. Yeah. That is the consensus view on the street right now.
Let's get this out of the way. I mean, everybody was writing important notes this weekend, including outlooks. We'll cover some of them for you, and I agree with you on the consensus there. I thought Darda was inspired.
Mike Darda?
Mike Darda. He went through a whole blah, 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 Wisconsin economics and, you know, the whole nominal GDP thing, and then he spent the whole back side of the notes saying that Chairman Powell ought to play Topgolf. Have you played Topgolf?
I haven't played Topgolf.
I've never played Topgolf. You go, it's like there's 3 branches in the Washington area, and Darda's like the F1Cs.
That's that fancy driving range.
Fancy drive-in range, and he said they got to get all on the same page, and you do that over a beverage of your choice at Topgolf.
So you have a beer and you play golf. Okay, sounds good. Do you want to try that? You ever played golf?
They used to ask me to leave the field.
Let's whip through the price action briefly. Up 0.2% on the S&P. Weaker losses last week on the S&P 500. The losses in crude. Let's just sit on that just a moment. WTI is down for a 7th session. WTI is down to the low 70s, just about holding on to a 70 handle, Tom.
This is a big deal.
On crude, $70.40. Last week on crude, biggest weekly loss going back to April. We were down 11% on crude. And Tom, that's even with the China reopening story.
Yeah, it is. Edward Morris publishing moments ago with Nathan Sheets over at Citigroup there looks, and he says, look, it's a tectonic shift in the next year. He nailed this lower price outcome, and he looks for, you know, maybe bounce around and all that, but he gets out to sustain commodity weight due to GDP. And the headline from Ed Morris is he goes bullish on gold, which we haven't heard much of. You and I have ignored that.
The headline on Brent, Citi cut their 23 Brent forecast by $8 today, down to 80 for next year. So they're coming in again, even for next year.
Well, I don't think we got a 69 print, 70.48, as you mentioned, on West Texas Intermediate, the American oil. But come on, how many people look for 69 print? I had Morocco, Croatia.
Morocco, France is competing with Chairman Powell. on Wednesday.
I didn't know that.
Yeah, same time.
Well, we'll have full coverage
You get a choice to make. Do you want Morocco, France, or do you want a little bit more of this
Actually,
Fed decision?
Telemundo is doing the Fed meeting.
We're going to have two screens, aren't we? We're going to have two screens.
Powell's going to come out and they're going to go, no dissent!
Telemundo would do a fantastic Fed special. Maybe we should swap. Maybe we should swap. Laurie Calvasini joins us now, head of US Equity Strategy at RBC Capital Markets. Laurie, I just want to start with Mike's words, and then we'll get to yours. Mike Wilson says the final chapter to this bear market is all about the path of earnings estimates, which we think are far too high. Laurie, are you on a similar page? Do you agree with that?
So I'm on a similar page with Mike, but I don't exactly agree with him. I think it's a little bit more complicated. So we're at 199 for next year. The consensus has been around 230, 231. And I do think that the need to pull those forecasts down is going to create some headwinds, some additional volatility, perhaps a retesting of the low. But does it have to make a new low? I'm not so sure. I think the main issue here is that the buy side wants certainty around multiples so that they can come in and buy and we can have a sustainable rally. All the buy-siders know, and they've known since June, that next year's numbers were too high. If you look historically, most of the cuts in down earnings years are in by April. And if you look on a single stock basis, when the rate of revisions to the upside is falling, you watch for it to turn positive again. You watch for that shift from negative revision territory back to positive revision territory. And stocks typically bottom the S&P 500 price 3 to 6 months before earnings estimate revisions for single stocks stop going down. What that means is that if we can kind of get all these cuts out of the way by March, it's still reasonable based on the historical playbook for October to be the low. Now, that doesn't mean we're not going to turn around, but I don't necessarily think that we have to break to a new low because of this earnings issue.
And making a time call, I know, is really, really difficult, Laurie, but what do you suggest people do between now and March?
So I think you have to back up and say, what have people already done and where are they? And most defensive sectors are near peak multiples relative to the S&P 500. And people have been loading into staples all year, rotating into healthcare since the summer. I don't think people have enough recovery trades for when we finally do put that final bottom in and start to recover. So we tell people, look at things like financials, look at things like tech. Look at things like small caps. Those are areas that typically outperform when you're coming out of a recession after you've made that final bottom. And small caps, frankly, John, are already starting to outperform. They put in their relative low back in May. So we think that people really don't need too much more defense. And, you know, I wouldn't necessarily dump all your defensive shares right now, but I would start thinking ahead to that recovery trade, not just this final turn.
Laura, I think of the great David Triple at Pioneer years ago, who had explained to me that small cap and mid cap go once every 9 years, once every 8 years, whatever the pop is. And I read in your research, you're really looking for that pop to be this year. If we have a great zombie roll-up, which frankly we're beginning to percolate and see because money actually costs something, how do small caps react to the fact we now have a risk-free rate? We have zombie companies that have to do something. How does that play into your call?
So I think you want to be in line with the higher quality small caps, the bigger names, the more liquid names, you know, kind of where the typical small and mid cap portfolio manager likes to invest, not kind of the bottom 3 quintiles of market cap where you tend to get the dicier balance sheets, you tend to get the lower quality names. We actually think there's plenty of valuation appeal in that upper echelon of small cap right now, which is one of the things that makes it so interesting to me because we haven't had that for a really long time.
Are small caps correlated to the weaker dollar, finally end of strong dollar international play? Do you cross-correlate those two categories?
I think that the dollar is complicated for small caps. They have been benefiting from an earnings perspective by dollar strength. If you try to sort of match up the relative cycle with the dollar over time, you're going to just want to pull your hair out because it's not consistent.
Watch yourself, Lori. Be careful with that statement.
But recently they've been benefiting from an earnings perspective because they don't have those pressures. I think that what I see right now, and I just got off a week of being in Europe talking to investors there, European-based equity investors are very perplexed by the expensive valuations that we have sitting in S&P 500 companies right now. You don't have that same valuation pressure down in small cap right now. So I think when you're starting to cross borders, I think you've still got the better valuation story here, and that will be appealing regardless of some of these current
But are they gonna roll up? I mean, I don't mean the quality small caps, and there's like 3,000, let's say, is a working number. What are the other 2,700 gonna do? Or is there gonna be one grand roll up because money finally costs something?
I mean, what do you mean by roll-up exactly, Tom?
Mergers, transactions, combinations, Microsoft taking out a teensy-weensy bit of the London Stock Exchange today just to get on board, that kind of stuff.
I think that you will get that in certain sectors where you have more valuation appeal. I think industrials, even though it's not cheap, is always an area where we see those roll-up stories, and the reshoring thesis could further some of that along. But I think ultimately those roll-ups and that M&A cycle, that's really more about what waits us on the other side of this recovery. In a sluggish GDP environment, growth is scarce. And companies, I think, will feel more compelled to go out and buy growth. And you can find that in some of those higher quality small caps, not necessarily the smaller ones. But again, it might bring you back to some of those higher quality, more liquid type names.
Laurie, you've touched on something really important here, and that's about leadership in the recovery in the second half of next year. Is it too early to draw conclusions about where that leadership comes from? That's a discussion we're ultimately having right now. Why is now the right time to have that conversation?
I think it's the right time because, you know as well as I do, John, when these bottoms happen and people are convinced of these bottoms, they just sort of take off and you don't have time to get in. You have to do your homework early while things are sort of quiet and churning around. But I'll tell you, last week we did have a lot of discussions about what is the new leadership. Typically in a sluggish economic growth backdrop, which I think is the price we pay for a short, shallow recession, growth stocks outperform. But is it the old growth or is it the new growth? And that's why I think a sector like industrials is starting to get a bit overvalued. Now, we're just neutral there. We don't like the valuations. But we have been talking to people a lot about how that might be the best long-term growth story in town, and that might be one of the reasons why you're seeing these valuations lift. People basically kind of looking at the old economy and saying what's old might potentially be new again, and that might be where you get sort of the better growth profile going forward.
Laurie, this was brilliant. Don't be a stranger. Come back soon. Laurie Calvasina there of RBC Capital Markets, just one of the absolute best, and we just had a 10-minute conversation on the market without talking about the Fed. What do you make of that?
I think it's good, and
Isn't
I think
that refreshing?
It's important. Yeah, Ben Laidler on this morning in a 5-page note, and he says, look, you can do all the Fed navel gazing. I'm sick of it. We have the Fed show here. And he says it's about markets, and markets will surprise and do better than the economy gloom.
On the Federal Reserve, did you read that piece over the weekend from Craig Torres and Liz Capper-McCormick?
Saw it.
Fantastic. Over the last
that's
5
really
interest rate
they're not even
cycles,
speaking terms,
the average hold at a peak rate was 11 months over the last 5 cycles. 11 months. And this market's pricing in
Pricing
what?
in like 6 weeks, 11 hours.
Cuts like a couple of months later after we hit the terminal rate. It's a pretty interesting debate, isn't it?
I think the parlor game, we're going to try to avoid that, folks, not only in the Fed show, but through this important week. When's CPI? Tuesday?
Tomorrow.
Tomorrow, yeah.
Tomorrow. You know what we won't avoid? This line from China in the last 24 hours. The top medical advisor in the country saying the risk from Omicron, the same fatality rate as the flu. Now, a lot of people might say the same thing in America, but to hear that from China is something,
it's a big number.
Real change.
Big number.
We're going to catch up with Enda Curran a little bit later.
Serious.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A man charged in the 1988 Lockerbie bombing of a Boeing 747 that killed 270 people is in U.S. custody. He's been identified as a former Libyan intelligence officer. The U.S. calls the suspect a third conspirator in the attack, saying that he helped build the bomb that destroyed Pan Am Flight 103 over Scotland. Germany's Chancellor Olaf Scholz will host a virtual meeting of the Group of 7 leaders today to discuss Ukraine's immediate needs. That's following Russian missile attacks on the country's energy infrastructure. Meanwhile, President Biden spoke to Ukraine's President Volodymyr Zelensky. The White House says the president affirmed the U.S. commitment to keep providing military and economic aid. In the UK, the government is planning for military staff and civil servants to cover for striking rail, health, postal, and other workers. Strikes are planned for almost every day through the rest of the month. Workers are demanding pay hikes that keep up with inflation. It's the biggest wave of industrial strife in the UK since the 1980s. The Federal Reserve looks set this week to downshift on interest rate hikes. After 4 straight 75 basis point moves to curb inflation, the central bank is likely on Wednesday to increase its benchmark rate by a half percentage point. Meanwhile, traders are pricing in Fed rate cuts in the second half of 2023. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, tomorrow morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report tomorrow morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
So I believe inflation will be lower. I am very hopeful that the labor market will remain quite healthy so that people can feel good about their finances and their personal economic situation.
Janet Yellen there, the U.S. Treasury Secretary, on 60 Minutes over the weekend, live from New York City this morning. Good morning. We'll talk a little bit more about that a little bit later. All right.
She was ramped sit on that up. Thought. It was right after the England
she had
game.
some things
they
to say.
Right after the English game.
You should have heard the language used
beverages.
in my household over the weekend.
Yeah.
Some select words.
Select words.
Futures right now up a third of 1% on the S&P 500. This week has a real final week of the year feel to it.
Yes.
CPI tomorrow. Federal Reserve decision coming up on Wednesday. Futures trying to bounce back by a quarter of 1% on the S&P. There is a rally in the bond market. Yields are lower by 5 basis points to 352.32 on a 10-year. I believe that's about 80 basis points off the peak for the year on a US 10-year. And a lot of people, Tom, lining up to say buy bonds into next year.
Yeah, price up, yield
Constructive.
down is the basic theme here. And again, you got a curve inversion at negative 80 basis points really hasn't done much. So it's a curve that's shifting up and down versus moving around like a yo-yo. We've got Horizon Therapeutics, a takeout there by Amgen. It's a real company, folks. I want to make that clear. These are people with free cash flow, Deerfield, Illinois, out of Dublin. And it's real science. It's immunology is a broad sense. And, you know, we'll have more on this. Is
26 billion, TK.
Yeah,
it's a real deal.
It's like a real, you know, we're all affected by this Twitter thing. These guys are going to go out for less price to sales, I believe, than what Mr. Musk took Twitter out. And Twitter's a shell of a company compared to, this is like real medicine, real finance, and away they go at Horizon Therapeutics, which is what China needs, except they don't have Horizon Therapeutics. They don't have efficacious medicine. What China has is hope and prayer. Enda Curran joins us, and usually on economics, but right now I think we've got to go to the society of all. How long was the weekend, Enda Curran, in Beijing, Shanghai, Hong Kong, and indeed west to Chengdu?
Clearly, Tom, events are moving at a very rapid pace right across China. Even through November, there was no hint of a pivot by the government when it came to COVID zero. December has been a totally different story.
Yeah.
The messaging out of Beijing now is that, as you mentioned earlier, Omicron is no worse than the seasonal flu. People who have symptoms are being told you can stay at home, don't be troubling the hospital hotlines. They're dealing with patients who do need care, for example, and that messaging is being rolled out right across the country in a fairly sharp pivot, trickling down to Hong Kong as well. Some changes on the cards here too, some talk of reopening the border with Shenzhen, which coming much faster than expected. Goldman Sachs today said all of these changes are going faster than expected. So all we know right now is it's been a pretty sharp pivot, but I don't think anybody knows where exactly or how exactly this will play out over the next 3 to 6 months.
And the longer you're going far away, an amateur like me, we had the great advantage of our People Worldwide folks, and particularly from Johns Hopkins University. We learned that the adults watch the hospitals. Tell us about the hospitals in China. Like, I know there's famous hospitals in Hong Kong and Shanghai and all that, but am I to believe that China is under-hospitaled for the state of this virus?
Well, you know, obviously it has its world-class medical facilities, but a lot of the expert commentary in the build-up to this outbreak was making the point it doesn't have enough of the kind of ICU coverage that, say, the likes of Japan and South Korea have. That weakness in its hospitals is clearly going to be a concern when you have an outbreak on the scale now that people are talking about, or our colleagues in Beijing are talking about and writing about. Anecdotally, there's obvious disruption going on at the hospitals in Beijing in terms of people turning up looking for admission and either can't get it or don't need to get it. And that was a similar story, by the way, in Hong Kong, when they were trying to manage COVID-0 while the disease spread as well. So I think no doubt that one of the concerns among China is the low vaccination rate among the elderly, and of course, whether or not the hospital network can deal with an outbreak on a scale of what's expected over coming months.
When it comes to reopening, Enda, what do you think they believe is the lesson from the West as they've gone through it in the previous 2 years?
Well, it's tough to note this one out, John, because a lot of experts are saying they're going to go through the same kind of exit wave that the West went through, that this is inevitable. China, some of the official messaging coming out of China are saying actually their vaccination rates are reasonably high. They're making the point that the vaccination rates of their elderly was higher than the vaccination rates of the elderly in Hong Kong, for example. So they're saying they may not have a Hong Kong style hit on the way out of this. But regardless, everyone is keeping a very close eye on how the coming 3 to 6 months will go. Nobody's quite sure how it will pan out, whether or not it is a severe public health crisis, or if they can navigate it, can mitigate it. Maybe it spreads at different speeds around the country. We're talking about a vast continental-sized economy. But regardless, people are wondering now on the other side of it what happens. Already it's clear that China is reopening faster than expected. We know in the interim it's going to be very bumpy, and of course public health is number one. But if and when China gets through all of that, economists are talking about maybe a faster growing Chinese economy next year than many expected as recently as only a few weeks ago.
That's what I wanted to get to, Enda. We really underestimated the potential for inflation to build and build quickly in Europe, in the United States as we reopened. What's different about China as it reopens? Why is the potential for that perhaps a little bit lower?
Well, again, you get different takes on this, John. There's an argument out there that China could actually put a bit of a floor under slowing global inflation next year. Let's say it reopens. You're going to have two stories on domestically in China. For example, this year, they imported the lowest amount of oil since 1990. Obviously, that wouldn't happen if China's economy was reopened and humming again. They would buy more input materials. They would need more commodities, so your iron ores and all of those materials, prices for those would go up or at least be kept steady. And then external China, you would have Chinese tourists, Chinese students, Chinese business people all traveling again, looking for airline seats, looking for hotel rooms, looking for real estate. So that's expected to spill over to global trading partners and put a floor under global inflation. So there are two ways of looking at it. People are saying there's a near-term China economy story, which is going to be pretty bumpy. But if and when China fully reopens and reconnects with the world, a humming China economy would probably add some inflation pressures to the rest of the world.
And very quickly here, what should we look for this week? I mean, as you said earlier, it's a moving story. Where are we on Friday, into the weekend, and into the holidays?
So every day they are taking down some of the defenses they had against COVID, either through signaling and messaging or, for example, these health and safety tracking apps that they were using. So keep an eye on what further barriers they continue to take down over coming days, Tom. That will indicate the speed at which they are dismantling this massive COVID-0 apparatus that had been built up right around China. And of course, don't forget, we're barreling in towards Chinese New Year, which comes early in January this year. And that's going to be a pivotal test for how willing the Chinese authorities are really to live with COVID.
The Lunar New Year, just around the corner. And Karen, thank you. What a change, and it's happened so quickly. And I go back to those comments from China's top medical advisor downplaying, Tom, the fatality of Omicron and comparing it to the flu. But TK, that's a massive shift in a really short amount of time from Chinese authorities.
Well, yeah, Chinese authorities, but is there only one authority, which is Mr. Xi? I mean, I take the point, it's a massive shift, but a shift to what? If they don't have the medicine, they don't have a program of vaccination. Maybe they're going to develop a program of vaccination within a totalitarian regime.
That's why I still think making a call on Chinese growth next year, Tom, is really difficult.
I wanted to go there with Enda.
If you get a clean reopening, maybe you can make a call. But as Enda pointed out, the debate right now, Tom, is whether we get a repeat of what happened in the West, which is stop-start and incredibly lumpy.
Thanks for listening this morning. Everyone, they don't care about inflation or the Fed.
Where are you going? Where are you taking this?
At the University of Cambridge, someone's, they slept in at Queen's College.
This is Mohammed.
He's
been snowed in.
He
wants more World Cup coverage.
Yeah, it's 20 above 0 Fahrenheit. He's snowed in.
Okay, what would you like me to say?
I want you to explain, and this came from a sophisticate, Mrs. Keene, why didn't England go down the field more and just attack?
I think they did. The initial tactics were spot on. They contained Mbappe. They turned the left side, the French left side, which is a massive strength, into a weakness. Saka really attacking Theo Hernandez. But ultimately, then the substitutions happened. And I think it was the substitutions that I just couldn't make sense of from Gareth Southgate over the weekend. But are we going to keep doing this? Give the UK a break. Give England a break, TK.
Okay. Croatia.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Coming off the back of the biggest weekly loss on the S&P 500 since September, going into CPI and the Federal Reserve. You know, that was really mean. That was really cruel. Futures on the S&P look like this. Positive a third of 1% on the S&P 500. On the Nasdaq, up a third of 1%. We're doing okay as we kick off the trading week. Into the bond market last week, 10-year yield just a little bit higher by 10 basis points. Likewise on the 2-year. Tom, the whole curve just shifted up a little bit last week, and now it's back lower again, right the way through the curve. Some flattening here.
My market to a 19 VIX, even an 18 for a cup of coffee, as we're back to 24.21 as we go into the Fed meeting on Wednesday.
Have we had the cathartic spike? That's what Julian Emmanuel of Evercore's talking about. Have we had the cathartic spike in the VIX yet?
I
He
like
says
Julian,
no.
John Golub. I'd like to know what they think as well. Everybody's got an opinion on this. What I know is there's some tension into Wednesday.
You're jumping in with the VIX. Let me finish the bond check. 10-year, 352. 2-year, 432. Crude looks like this. 7-day losing streak on WTI. We're down 0.75% on crude. On Brent, we're down 0.75% also. And we are clinging on to a 70 handle. We have just had the worst week, biggest weekly loss since April on WTI crude, Tom. Make sense of that.
It makes sense, as Ed Morris is, you know, we're talking about Mike Wilson and equities. What Ed Morris did in oil is just shocking. I believe Deutsche Bank was there.
Great call. Fantastic.
Great call.
Busy week ahead for markets. You're going to hear that all week. CPI data tomorrow. Later in the week, retail sales, then Eurozone PMI and CPI, plus 9 central bank decisions on tap, including the Federal Reserve, ECB, and Bank of England. All of that clearing the path for investors to look ahead to the new year.
If you look at where we are, for the U.S. economy, of the Eurozone economy next year, is there still a chance of recession? Absolutely, right? But probably at best in a mild one, both in the U.S. and the Eurozone. Of course, how the war develops is going to calibrate that too.
Jeff Yu of BNY Mellon, Tom, looking ahead to next year, and you know the conversation. We're having a conversation about the potential for a recession, and it's just not in the data yet. It's in the market. We can talk about that, but you certainly don't see it in the labor market right now, do you?
Yeah, I go segmented here, and a lot of people say I'm wrong here. There's a part of America right now that is in recession. But, and you can decile it or take half of America, whatever you want to do. There's a lot of pain out there. While there is a buoyant, employed America, are they booming? I think boom is not there, but
to your
good.
point,
it's good.
I think even last year, when the GDP data was so much better, consumer sentiment was pretty soft given everything we'd seen in the last 12 months with gas prices and inflation. And TK, you've made this point many times, I think we all have around this table. There's a massive difference between how people feel about this recovery over the last couple of years and what the data tells you.
And again, it's what the markets will do, and the economics of it is maybe an underpinning, but they can be separate, and I'm hearing that in a lot of outlooks right now. Let's outlook right now at Stifel with our chief economist, Lindsay Pieggs, that joins us right now. Lindsay, I don't want to get into the silliness of pivot this or pivot that. Where are we right now? What is your real GDP call for this ending Q4?
Well, I do think there's enough momentum or ongoing resilience in the consumer that we will see a second quarter of positive activity, albeit markedly below the near 3% pace we saw in the third quarter. But the bigger question is, can we maintain that going into 2023? And I don't see that resilience being able to be maintained as we continue to see some of these variables increasingly weigh on the consumer, i.e. elevated prices, negative income growth, negative manufacturing activity, a housing market that's under extreme pressure. So I think that we can argue you can check the recessionary box for nearly every sector of the economy, even at this point, except for the labor market. But even there, we're starting to see cracks. We're starting to see signs of emerging weakness. So while we do maintain that positive trajectory through December, I think 2023 is opening the door for recession.
Let's do Algebra Monday, Lindsay. It's Y equals, I don't know what it is, C plus I plus G plus NX is out there somewhere. Can you split your analysis between domestic final sales and real GDP? Can you pair off trade dynamics? Are they part of getting to a recession?
Oh, absolutely. And I think when we parse through the trade and inventory data, that's really what complicates the earlier weakness that we saw at the start of the year and why it's likely that we don't see a technical recession in hindsight called for the first 6 months of 2022. Because when you strip out that volatility from trade and inventories, we see that we actually had positive momentum from December into the first quarter of the year. So this is very much complicating the picture and will continue to complicate the picture going forward. If we look at third quarter GDP, Now, one of the largest contributors to that top line increase was trade, contributing nearly 3%. But a lot of that was reflective of the weakness on the import side. And that reflects a declining demand, or a level of declining demand on the consumer part, again, highlighting the fact that consumers are on increasingly fragile footing as we turn the calendar page into the next year.
Lindsay, there will be some people tuned into this program right now listening to another recession call for 2023 and wondering why on earth the Federal Reserve is hiking interest rates by 50 basis points on Wednesday and probably signaling they're going to do a whole lot more after that. Lindsay, how do you reconcile those two things?
Well, remember, the Fed is trying to slow the economy. So the fact that we're seeing increasing calls for recession in 2023 means that the Fed's earlier policy initiatives are already having the intended effect of tapping down investment, tapping down consumption, and resulting in a significant slowdown in the economy. Now, the reason the Fed is so focused on continuing to raise rates, not necessarily at the supersized 75 basis point increase that we saw earlier, but 50 basis points, and as you said, more work to come down the road, is because inflation is still elevated. And at this point, with the labor market still arguably on modest footing, the Fed is hyper-focused on bringing down inflation, reinstating price stability, which the chairman has said time and time again is the bedrock of the economy.
So how much more damage do you think another 100 basis points of heightening does?
Well, I think it ensures that we do see recessionary conditions, but depending on the behavior of inflation, depending on what we see in terms of international factors, that will determine the depth and duration of the downturn. But again, from the Fed's perspective, it's not about whether or not we see negative activity. It's about whether or not we can get inflation on a meaningful downward trajectory back towards the committee's desired 2%-ish target range.
What's your probability of getting back to 2% until England wins in football again, Lindsay? I mean, come on. Where are we getting back to 2%? 25 or is it 26?
Well, if you look at the Fed's trajectory, they're still very optimistic that we're going to see a two-handle by the end of 2023, maybe early 2024. But I think the reality of the data suggests that committee members have been calling for this meaningful improvement in inflation for the better part of the past 2 years, and we simply have not seen that come to fruition. So the Fed, the market continues to underappreciate the complicated nature of the inflation equation at this point, and that's why, along with a 50 basis points increase this week, we do expect the Fed to meaningfully revise higher their expectations for policy and inflation going forward.
Now, this PX at 101, it's service inflation, isn't it? I mean, we're going to get a reversion. And David Malpass at World Bank was great on this years ago. We're going to get a legit goods disinflation, dare I say, true deflation. But services isn't going to get there. What do you see as a sustained services inflation above 3%?
I think that's absolutely reasonable, but you're right. We are going to see this bifurcation between goods and services, and already we're seeing it in the data outside of inflation. Manufacturing turning back into contractionary territory while we look at the ISM Services Index, and that is still arguably on solid footing. And so this bifurcation, again, does highlight the difficult nature that the Fed is going to face in trying to tackle broader inflation pressures, particularly as we see this wage price spiral continue to accelerate.
Lindsay, you and John are way too young to understand this. We survived this before. If we only come down with services elevated to 5% or 4% or 3.8%, life goes on, right? People adapt, right?
Absolutely. And we will come out of this, but I think the trajectory of how we come out of this depends on the Fed's resolve to reinstate price stability. If they start to get cold feet, if they start to pull back prematurely, then we could see inflation become entrenched in the economy, meaning that we don't see that improvement back to the Fed's 2% target. But if they stay the course, it will be more painful in the near term, but we could see the economy emerge faster and with more gusto as we begin to get back to a potential level after that 2% target is reinstated.
Hey, Lindsay, thank you. Lindsay Pieksa there of Stifel. Tom, this coming at the same time we're having conversations about maybe shifting the inflation target from 2 out to 3. Alerian talking about it in the FT potentially pushing back against the idea at the moment. Heard the same thing from Bill Dudley, also pushing back against the idea as well. Where did this come from? Was this Adam Posen that started this? You shift to 3, you go from 2. Who was it?
Dr. Posen has been such a supporter of the program. Remember at Jackson Hole?
Yeah. He came out in shorts and a T-shirt, and we were freezing.
Or something like 12 below zero. Folks, the heritage of this is the courage of Olivier Blanchard and the laureate Joe Stiglitz. I'm going to guess 2009, where they just said, let's frame out 4% inflation. And people went mental. I mean, people went absolutely apoplectic over this 4% number. And it's modeled, and Adam is very clear to say his 3% path is, with nuance, is different than what his colleague Olivier Blanchard says you get to 3%. My answer is put a band around it. I mean, 3% may be 2.7% or whatever. How far is that from a John Taylor like 2%? My answer is we're splitting hairs here.
The backdrop matters. I think you start questioning the inflation target at a time where inflation is too high. I think people start questioning your credibility to hit even 3, never mind 2. Tom, isn't it just a time horizon question? Don't you just turn around and push it out?
Yeah, well,
another 12 months?
Like, yes, but it's like when England was unanchored, they put in sterling. What did sterling do when he came in?
Let's go there.
What did sterling do when he came in?
Is this punishment for 10 years of trolling the Red Sox? Is that what this is?
Don't go there. Come on. I'm moving to San Diego.
We mentioned this earlier. For people just tuning in, the big worry was Mbappe. Kyle Walker did a phenomenal job down that side. Mbappe was almost absolutely contained. And as I mentioned a little bit earlier, that was meant to be the strength of France down that left side. Theo Hernandez is also really quick, the left back. They turned that side into a weakness. Saka was phenomenal. He was terrorizing that defense for about 90 minutes.
Saka was the best player in the field. But
so why was he taken off?
I don't know.
That's ultimately the conversation.
We're sitting there with a beverage of my choice, and I'm like, what? But
that's the conversation we're having.
To me, come on. They kicked the ball from farther out. That's about the first goal.
Is that your match day analysis?
Yeah, it's my analysis. Kick the ball.
How do you feel about Harry coming back to Spurs?
Don't you think?
How's he going to feel?
No one knows. No, I think it's,
to miss a penalty with the stakes that high. It's a lot of pressure. But Tom, do you know what? Out of everybody, who would you have picked to take that penalty? That spot kick, you wouldn't have picked anybody else apart from Harry Kane. You wouldn't have picked anyone else.
This is a knowledge base, folks. I don't have. All I know is Argentina wears a blue jersey and France wears a blue jersey.
And that's why they're in the final of your bracket, and that's why you have absolutely wiped the floor with me in our Bloomberg brackets.
What is it, the 18th is the finals?
Next Sunday. This Sunday.
Yeah, Bistro,
You want to watch it together? You missed the viewing party Saturday.
I did miss the viewing party.
We'll talk about that later.
Did AMH behave herself?
Anne-Marie turned up.
She was mental.
Futures up a third of 1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, COVID is rapidly spreading through households and offices after the country's pandemic rules were eased. Now that's led to turmoil in poorly prepared hospitals. Some facilities are struggling to find enough staff and others are suspending non-COVID treatments. President Biden and Treasury Secretary Janet Yellen have reaffirmed U.S. support for Ukraine. CBS asked Yellen about how long American support can carry on, and she replied, as long as it takes. Meanwhile, President Biden told Ukraine's President Volodymyr Zelensky the U.S. is committed to aiding Ukraine and holding Russia accountable for the war. Scientists in California have made a breakthrough in nuclear fusion technology. Bloomberg's learned that for the first time, they've produced more energy than consumed in a reaction. It took place at the Energy Department's Lawrence Livermore National Laboratory near San Francisco. While the results are considered an achievement, it's still a long way to creating a viable technology. Microsoft has agreed to buy a stake in the London Stock Exchange Group. The move will give the software company a 4% equity holding, which is currently valued at about $2 billion. The stake is part of a long-term agreement to help LSEG develop data analytics and also cloud infrastructure using Microsoft's products. The group will spend a minimum of about $2.8 billion on cloud services over the next 10 years. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You gotta be, you gotta show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You gotta show up. You gotta be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
The danger of this war is extraordinary, and it can go on for years. But this oil and gas thing, it looks like the Europeans will get through it this winter. But this oil and gas problem is going to go on for years. So if I was in the government or anywhere else, I'd say I have to prepare for getting much worse.
That was Jamie Dimon, the JP Morgan CEO, on CBS over the weekend from New York City this morning. Good morning. CPI data coming tomorrow morning. Then it's on to a Federal Reserve decision. Going into all of that, equities elevated by just 0.25% on the S&P 500. On the NASDAQ, up by about 1/3 of 1%. Yields are down. Treasuries are up, 352.14. The whole curve shifting lower. Just a bit of curve flattening in the mix here, Tom. That move lower, led by 10s and led by 30s.
I'm going to call it resilient dollar here off the blush. We had a strong dollar, and we've given
just
it back.
about.
We all know that story, but it's sort of like churned here. I think waiting for tomorrow's
data. It's been a massive turnaround there, Tom, from the end of September for euro dollar to go up from, 95 to about 105, 106 at the moment.
Shillelagh Bassett will know better than me, but is out shut down for the year? I mean, certainly after Wednesday.
So after Wednesday,
boom, gone.
Year over. I'm out. I'm taking the rest of the year off after that.
You are?
Yeah. I don't know if anyone noticed that yet, but we'll work it out.
Are you going to leave it like 232, or are you going to leave?
Last time I did that, then the Bank of England hiked interest rates, didn't they? You've still got the BOE and the ECB on Thursday. Then after that, as far as the schedule's concerned, we're done. I think a lot of people want to wrap this up and call it a day on 2022.
Well, what we'll do is a day afterwards, when we have ECB, Bank of England, we'll break out the Tang mimosas.
Oh, nice. That sounds special.
We're going to talk about Horizon Therapeutics. It's a really, really interesting story. We'll get to that here in a few moments. Right now, the story that matters to you, the big shock here of oil coming in a breath of fresh air with the concern of refined products. Stephen Schork briefs us. His research note with the Schork Group and the Schork Report is absolutely definitive on dynamics on valves in pipelines. Stephen Schork, what is our integrity now of our system if we get a cold like Aberdeen, Scotland is getting?
Yeah, absolutely. In a lot of dire straits here. It has to be cold as far as the distillate market, Tom. Here in the Mid-Atlantic and the New England market areas, the Northeast United States consumes 70% for space heating, home heating oil. And right, there's still a dearth of product. We've had a significant sell-off over the past week, a week and a half in this market. And quite frankly, my clients, the heating oil, the people on the boots on the ground, people who have to consume, they buy and they sell and they distribute heating oil, they're perplexed by the move lower. They cannot find product. It's very difficult for them to find product, and yet prices are still moving lower. So it is a conundrum for some of my home heating oil people here in the Northeast.
I look at Javier Blas with a great chart out this weekend as he writes up his Bloomberg opinion piece on the spike, the surge in English utility costs. Do we get the same surge if we get the same cold, Or are we managed in a way where distillates, core oil, gasoline, diesel, the rest of it, where we don't see a spike like they see in Europe?
We won't see quite the spike that we're seeing, but we have, and we will continue to see a spike in demand, not only for home heating oil, but of course our electricity costs, our natural gas costs are sky high relative to recent norms. Tom, probably the only market, if you heat with propane, that is the only market here in the lower 48 where there is an actually surplus of propane. We are swimming in propane, whereas in our other heating BTUs, be it distillate fuels or natural gas, there's virtually no product.
And that's a pizza thing we got in the deck. I mean, it's like killing us. We're using that 6 days a week now, propane.
That's how you stand warm.
It's like a hockey goal.
You got the kids eating outside with propane.
We got 3 pieces in there. It's like Famiglia up.
You're absolutely ridiculous.
Please.
Stephen, can you talk to me about the demand-supply backdrop going into next year? We've drained a big chunk of the SPR. Europe managed to refill natural gas, but only doing so through Nord Stream, and they got through most of this year, the back end of this year, because the cold snap didn't kick in until now. Stephen, I want to understand the dynamics into next year. You heard that warning from Jamie Dimon at JP Morgan. Can you run us through that?
Well, right now, of course, I'm going to agree with Jamie that the long-term structural imbalance between supply and demand globally is not going away. And yes, we have, for the moment, dodged a bullet with regard to the start of winter and the Ukraine war, but we're not addressing the long-term issues of bringing more infrastructure to sate growing demand. The narrative has shifted to a point now where it's moved away from supply, which has been the real bullish driver, and now it's a demand picture. I think all the Wall Street banks now are singing the same chorus about economic contraction in the first half. If we look at the Federal Reserve Bank's favorite recession indicator, the 3-month 10-year yield, it has rarely been as bearish as it is currently trading on the inversion right now. So, and then, of course, we look at the employment numbers. Now, the latest job numbers seem to be relatively constructive, but once again, people are not working, especially men in their 20s to 40s are not working. And we're looking at a huge chasm between the household numbers and the establishment numbers. One survey of jobs says, yes, jobs are growing. The other one says, no, jobs are contracting. And the one that says jobs are contracting really melds with what we're seeing in the tech sector. Tech, the white collar, the haves are now starting to see massive layoffs they haven't seen since the Great Recession. So there's a lot of minefields to kind of navigate in the first half. It's certainly pointing towards an economic contraction, and therefore that is really, I think, the overhang on the market right now. We're worried less about supply and more about dwindling demand for the new year.
Is that worry about demand misplaced given China's reopening? Can China fill the gap even if we do roll over next year?
China can absolutely fill the gap, and there is that demand, but they were giving a nice little gift by the West. They were giving a fantastic negotiating price, saying, okay, Russia, you can't sell your oil for more than $60 a barrel. Now, of course, the Indians and the Chinese will continue to buy Russian oil. They will buy it above $60. I mean, they will negotiate, but they're in a far better negotiating deal. So while this demand will continue to grow as China continues to lower their mitigation protocols, they're still going to be buying oil at a well below market value.
Stephen, one final question, really important. How's that electric vehicle thing going? I mean, you follow it tangentially over from your expertise in hydrocarbons, but from where you sit, how's EV doing?
EVs are going to be the biggest drain on the environment that will make 120 years of mining for coal and oil look like like they were members of the Sierra Club here. The amount of rare earths we have to dig up. Now, personally, guys, I drive an electric hybrid. It is a 17-gallon tank. I just had to refill my car. After not filling it for 2 months, I drove nearly 1,400 miles on a combined electric 17-gallon tank. That's the wave of the future. And so what I'm getting at here is like compromise. We have to work together. Right. It's not a zero-sum game.
We are the people. No. Stephen Short, thank you so much. John, this is just down. I stood in Detroit at the North American International Auto.
The international piece of that is important.
And Mercedes said just what Stephen Short said. The certitude each way is baloney.
We caught up with Mercedes on Friday. You missed that.
I missed that.
We caught up with the CEO.
You
know, they've had to drop their prices on that offering in China. They had to drop their prices. Working out what's going on in China right now when it comes to the big autos.
Tesla in China?
So I spoke to Ed Ludlow about Tesla in Shanghai and reduced factory hours. And I was trying to work out, is it production line upgrades or demand, one or the other or both? And he said perhaps a little bit more about production line upgrades than a weaker demand picture. But I guess we'll see. We'll see. Apple have got similar issues over there at the moment on the production side.
Can we talk science?
By all means.
Immunology. Horizon Therapeutics is taken out today by Amgen. This is a legit company with legit size, Deerfield, Illinois, Dublin, and the rest. And what's great about this, for those of you on radio, the academics of this crew is heavyweight. And these are people that went to all sorts of schools like Muhlenberg in Pennsylvania, Franklin and Marshall, and the fabulous Harvey Mudd out on the West Coast. And they got lots of graduate degrees and ramped it up first in science. And the best thing about this is the leader, Tim Wahlberg, was actually a patient. He was grievously ill in immunology years ago.
That's amazing.
That's how we got into it. It's a great story. It's, you know, I don't think there's enough said about this, about these biotech companies. They got prodigious academic chops, and then to do the financials that they've got with Andy Pasternak came from Bain and Company, and you know, they put it together, boom. You know, today's
$26 billion deal, 20% premium.
Muhlenberg is going D1 hockey. That's what it means. I can just see, you know.
Were you D1 hockey?
No, I was not D1 hockey at the time.
What division were you?
Division 5.
Division 5?
Yeah.
Was that because you wanted to go to a party school?
No,
is that what that was
although
about?
there was the time where the rink was sold out and the streakers went by, and the next, I was on ice.
Okay.
I'm on ice, and the place goes mental, and I think there's a fight. And it's 3 guys going naked around the top, going, "Go Tigers!" And they made the national news the next night. That's that kind of hockey.
Do you want to share what year this was?
This was a few years ago. Yeah, the Zamboni you pulled.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
The Fed doesn't want to actually grasp the nettle and tighten financial conditions.
We've got them going 50 now in December, 50 in February, and another 25 in March.
We think that next year what we're going to see is a Fed that's continuing to tighten.
The biggest risk is if they under-tighten because they've sent such a strong message about needing to get inflation down.
These stagflation problems that we've seen this year, they're not going to go away anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This was supposed to be a World Cup free zone for the duration of the program.
It's been a success.
But you are refusing to drop it, aren't you?
I want to like hang out like they do in Qatar, you know, no tie on, and they got the shoes with the white soles. And
have you noticed that? I'm not into that.
Yeah, I agree.
The sports presenter with the suit and the sneakers. I've got no time for that.
I'm having fun with it.
From New York City this morning. Good morning to you all. Equity futures are just about positive on the S&P 500. We've got a big week coming up. We've got CPI coming up tomorrow. The Federal Reserve decides on Wednesday. Bank of England Thursday, alongside the ECB. What more do you want?
What you want is clarity, and we got that from Lindsay Pieggs at Stifel. I thought she was great on this parsing of goods inflation back to a disinflationary trend of some form.